The first one is the PP account, basically to determine whether there were some PP which were acquired. Remember, just like the other question we said, in case there are some items of PP which were acquired, the examiner will not give you that. It's upon you to do what? Basically to prepare the PP account to determine what? The PP which were acquired during the current year. Number two, we will also prepare the accumulated depreciation account. The main objective of preparing that account is basically to determine whether there was or actually to determine the depreciation for the current year. But basically, we're going to prepare those two accounts after going through the other additional information. So let's first of all, we go to note number 2, and you're told on 1st November 2024. This is at the start of the year. The company revalued its property for the first time to a fair value of 24 million. So in this case, if you are told property usually comprises of land and buildings. So property to its fair value of 24 million. So we are told the cost of land is 6 million. So automatically the difference here is the cost of buildings, because we are told a property, we are given property fair, and actually in this case we are told the property was revalued. So the revalued amount in this case we are told is 24 million. And I hope you can see our figures in the income statement of financial position. Those values are in thousands of shillings. So we need to be consistent. We will work with our figures in thousands of shillings. So the property, which I've said comprises of land and buildings, land and buildings. This one was revalued to this one, 24 million. And basically we are told that the cost of land, or basically the revalued amount of land here is what? Is 6 million. So automatically the difference here, which is 18 million, this is the revalued amount of what? Of buildings. This is the revalued amount of what? Of buildings, because I've said property comprises of land and buildings. Yes. And then you're told the property had a cost of 25 million. So the cost of land in that 25 million is 5 million, and the building was being depreciated on a straight-line basis at the rate of 2% per annum, and had a remaining useful write-off that year at the date of the revaluation. At the date of what? Revaluation. So, and then you're told that the company does not account for the deferred tax on this revaluation. There is a topic you're going to discuss on deferred tax, and basically we'll be able to see that anytime the company revalue an item of PPE and there is a revaluation gain, the company usually computes something called the deferred tax on the revaluation gain. But if you check here, we are told the company does not account for that deferred tax on the revaluation gain. However, it makes an inter-reserve transfer for excess depreciation upon what? Revaluation. So I think in our case, what we need to do here is basically to compute what? We need to compute the accumulated what? Or actually, we need to compute the excess depreciation here. The excess depreciation. Do we compute it at this point, or we compute it as we prepare the PP account? Yes, let's compute that as we prepare the PP account. Remember, I've said we need to prepare the PP account and the accumulated depreciation account. Yes, let's first of all skip that. We will basically come back to that equal to note number 1. So let's first of all move to note number 3. And in note number 3, we are told during the year which ended 31st of October 2025, a motor vehicle which had a cost of 2 million and accumulated depreciation of 800,000 was disposed of for a cash profit of 1080. The gain or loss on disposal was included within the distribution. I think this one is quite simple. Because we are told there was a motor vehicle which was disposed. Remember, I said that anytime the company disposes or sells an asset, we need to compute the gain or the loss on disposal. How do we compute this particular gain or loss on disposal? We said we take the sales proceeds minus the net book value, or basically the carrying amount, of which we say that this one is equal to the cost minus the accumulated what? Depreciation. So in our case, we are told the motor vehicle, which was disposed as per note number 3, was disposed, or actually we are told its cost was 2 million and accumulated depreciation of 200,000. So the cost was 2 million, and you have said we are working with all our figures in thousands of shillings. The accumulated depreciation was 800,000. So meaning that the net book value of the carrying amount, this one was 12. And then you're told it was disposed for 1020. That is the proceed. So meaning that here it was sold at an amount which was less than the carrying amount. In other terms, if you take this minus that will give us a negative. That one will give us a negative, which automatically is the loss on disposal. So what is the loss on disposal here? Is it 180? The loss on disposal? The loss on disposal, is it 180? Is it 180? Is it 180? 180? 180? Yes, 180. So remember, when preparing the statement of cash flows, there are two items you're going to consider here. Number one, this one, the loss will have to be added to, will be added back to the profit before interest and tax. And number two, when computing the cash flow from investing activities, we said we take into account the sales profit. How much amount was received from the sale of that asset? So we are done with that. So, but also remember this information which we have in note 3. We will also use this when preparing the PP account. Let's move to note number 4. And you're told the company acquired new investment in equity instruments for a cash and designated them at fair value through other comprehensive income. Remember, in the topic of financial instruments, we talked about financial asset. Financial asset, we said it is investment in equity instrument. It is investment in shares. So we are told during the current year, the company acquired new equity, or actually the company acquired new investment in equity shares. In other terms, the company acquired additional investment in what? In shares. And actually designated that, or actually classified those particular investment as at fair value through other comprehensive income. Now, where do we have information about that? Where do we have information about the financial asset? Remember, this was the abbreviation for those financial asset at fair value through other comprehensive income. And remember, we said that these are equity instruments which are acquired by the company, and the company has an intention of holding them on a continuing basis. The company has an intention of holding this equity instrument for a long period of time. That's why we say these ones are basically classified as non-current asset. If you go back to the balance sheet of this company, specifically at the non-current asset, you'll be able to see something called equity or investment in equity instrument. Now, that investment in equity instrument basically is what is a financial asset at fair value through other comprehensive income. Investment in shares, the company intends to hold these shares for a long period of time. Now, here you can see at the start of the year, the value for this equity instrument was basically 0, but basically it has increased all the way to 12,100. That's why we are told in note number 4 here, this investment in equity instrument was acquired during the current year. So in this case, you can see therefore, this has an increase of 12,100. But remember what we said, this particular investment in equity instrument, they're recorded in the statement of financial position at their fair value. So they must be remeasured to their fair value at the end of each year. Now, if you can be able to recall in the income statement, can you go back to the income statement? Can you go back to the income statement? In the income statement down there, where we have the profit for the year, we have other comprehensive incomes. Now, these other comprehensive incomes, basically, we have 2 items. We have the gain on property devaluation, and then we have fair value gain on equity instrument. So basically, this investment in equity instrument, which was acquired by the company during the current year, their fair value increased with 600,000. So the company bought some shares during the current year, but when the year was coming to an end, their market value had increased with 500. Now, in our case, what we want to do here, we want to determine how much cost was paid by the company in acquiring these shares. So automatically to be able to determine the cost, because whatever you're given here, this is the fair value. And this fair value of this equity instrument, this one includes the gain. Include that gain. Can you be able to know how much amount was paid by the company? For example, you bought some shares during the current year. We don't know the amount which you paid, but we know that at the end of the year, these shares will be having a value of 50,000. But equally, we are told that the value for these shares has increased with 10,000. Now, in this case, can we be able to determine the cost you paid in acquiring these shares? Because that's what we need to know here. So we know that the market value of the shares at the end of the year was 50,000. The market value increased with 10,000, but we don't know the cost you paid. Can you be able to determine the cost which was paid here? Then Can you be able to determine the cost which was paid here in acquiring these shares? I hope you're understanding this, whatever I'm explaining here. We are saying you bought some shares during the current year, the shares which are trading in the securities exchange market. Now, we don't know the cost you paid, but we know the market value of those shares at the end of the day is 50,000. And we are told since you bought those shares, their market value has increased with 10,000. Can you be able to determine the cost which was paid in acquiring those shares? Can you be able to tell the amount? Can you be able to determine the cost you paid in acquiring those shares? Yes, it's automatically very, very simple, this one. It's automatically very simple. Dagote, can you be able to determine the cost? Yes, the cost is automatically the market price minus the increase in the fair value. So you bought them at 40,000. You bought them at 40,000. And if you add this increase in the market price, you get the fair value at the end of the year. The same case here. The shares which were bought by the company, we are not given their cost, and that's what we want to know, how much cash was paid, but you are given their fair value at the end. But we know that this fair value has increased with 600. Has increased with 600 as per the income statement. So meaning that we can be able to know, to determine the cash which was paid by the company. So the cash which was paid by the company in acquiring this equity, this investment in equity instrument will be this minus that. So how much is that? It is 11 what? It is 11,500. That is what we want to determine, because in preparing our statement of cash flow, specifically when computing the cash flow from investing activities, our interest here is basically to determine, our interest is the cash which was paid. The cash which was paid is not this one. The cash which was paid is 12,600, which is the market value, minus that gain, minus increase in the market price, minus that increase in the market what? Minus that increase in the market price. Yes. Now we have that. Note number 4. Note number 5. We are told during the year which ended 31st of October 2025, our company made 1-for-5 bonus issue of ordinary shares with rising share premium. We came across this in our previous class. We said once the company make a bonus issue, there is no money which is received here. So let's first of all determine the bonus shares. How many shares were issued free of charge? So we are told the company issued 1-for-5. 1-for-5, how do we interpret that? We interpret that, or basically that means that during this bonus issue, the company was to issue 1 share for 5 shares which were held. Now in this case, we said we need to determine the shares which were held at the start. So we go back to our balance sheet at the equity. And we take the share capital at the start. The share capital at the start was 20. I hope you can see that. But basically, these are not shares. We say divide that with the par value per share. The par value per share is what? Still in our balance sheet where we have the word ordinary share capital, the par value is 10. So meaning the shares which were held at the start, they were 2,000. So we cross multiply, then we divide. So in this case, we have 1 times the 2,000, that is, divided that with 5. And basically, this will give us what? This will give us 400 shares. So the shares which were issued during the bonus issue were 400. And remember, in this case, we said during a bonus issue, the shares are issued at their par. Exactly the same thing we did in the other question. So that is these are the shares which were issued during the bonus issue. Now, meaning that this particular 400 shares, and I hope my computation is correct. So the 400 shares, which were issued at a price of 10, so the company received 4,000 shillings. So how do we account for this amount? We say that this one should be credited in the share premium account. And then we credit the ordinary share capital account. We credit what? The ordinary share capital account. That is basically the double entry for this. And therefore, we said in relation to this bonus issue, we have to prepare 2 accounts, the ordinary share capital account and the share premium account. So why do we have to prepare those 2 accounts? For us to be able to determine the shares which were issued for cash. So let's prepare those 2 accounts. We prepare those 2 accounts. And I hope you can see this question, in fact, has so many similarities with the other one which we did. Because also in that question, we had a bonus issue. There was a disposal of assets. Yes. So let's start by preparing the ordinary share capital account and then the share premium account. And I've said the reason why we are preparing this account is to determine the shares which were issued for cash. And in this case, I said whatever you record in this account is the opening balance, the closing balance, we record it here, the closing balance. Then these bonus shares must be credited in this account, the bonus shares. The bonus shares, and we know the bonus shares at this value, 4,000. And then this account mostly will be having a balancing figure on this side, and these are the shares which were issued for cash. That is what we want to determine, which will be the balancing figure. Then we do the same. We record the opening balance in this account, the closing balance. Then these shares which were issued free of charge, the bonus shares, we are saying they should be debited in this account. So we have the bonus shares, which are the value of 4,000. And then we will have a balancing figure on this side, which now will be the cash, which was received from the shares which were issued. These shares which were issued, you'll be able to see they were issued at a premium, which will be the balancing figure here. So let's first of all start by recording the opening balance and the closing balance in the share capital. We get this from the balance sheet at the equity. From the balance sheet at the equity, the ordinary share capital at the start, this one, was 20. At the end was 40. Was 40,000, like that. Yes. So then if you balance this account, you can see the total on this side is 40. The total on the credit is 24. We have a difference of what? We have a difference of 16,000. Now, this 16,000 automatically are the shares which were issued for cash. And that is what we consider in our statement of cash flows. The same case here, we record the opening balance. We are getting this balance from our balance sheet at the equity. The opening balance here is 4,000. The closing balance here is 4,000. 4,000, 4,000. So the total on this side is 8,000. The total on this side is 4,000. So meaning that we have a balancing figure here of 4,000. And this is the share premium which was received in cash. That is what we are going to consider in preparing our statement of cash flow. That is what we will consider there. So I think we are done with that point number 5. And then I think point number 6, you're told all the sales and purchases were basically made on credit. Okay, so I don't know how that is supposed to help us, but I don't think we have any working for that. Now, what I want us to do, I want us to go back basically to point number 1, 2, and 3. There are basically a number of accounts we need to prepare there. The number of accounts we need to prepare there. The PP account and accumulated depreciation. I hope you can see, for example, with this question, like unlike the other question which we did, we are not given the depreciation for the current year. Are we given the depreciation for the current year in the additional information? No. We can only compute that by preparing the accumulated depreciation account. In this question, equally, we are not told whether there were some items of PP which were acquired. So we can only be able to do that by preparing the property, plant, and equipment account, of which in this case, we'll be able to see that in terms of how we prepare this account, there will be a slight difference because the PP account here, we have to prepare it at cost. And then we prepare another account, which is called accumulated depreciation account. But I think before we do that, let's, first of all, we go to note number 2. There is something we need to compute in addition to note 2. So let's go to note 2 first of all. We are told on 1st November 2024, which is at the start of the year, the company revalued its property, of which I've said property is land and buildings, for the first time at a fair value of 24 million. Fair value is the same with the revalued amount. So if you're told assets were revalued and you're given the fair value, that is the same with the revalued amount. So 24, and actually we are told that included here is the revalued amount for land, 6 million. So meaning that buildings were revalued at 18 million. And then we are told the property had a cost of 25 million. This property which was revalued had a cost of 25 million. And you're told included in that 25 million is the cost of land. Is the cost of what? Is the cost of land. Cost of land. So I think maybe before we move to the other event, to the other sentence, remember, anytime the company revalue an asset, we usually have a revaluation gain or basically a revaluation what? Loss. Anytime the company has revalued an asset, we have a revaluation gain or a revaluation what? Loss. Now, how do we compute this revaluation gain or loss? Basically, to compute this, we compare two values. We compare the revalued amount, which in other terms is the fair value. For example, in our case, we know that this property was revalued to 24 million. So we already have this. So we compare this with the net book value. With the net book value, or basically the carrying amount of the asset, which was revalued. And then in this case, we get a revaluation gain or a revaluation loss. Now, in this particular question, the examiner has not given us this. Because if you check on what you're given in note number 2, we are given the cost of the property. So are we supposed to compare this with the cost? No. We need to compare that with the net book value. And actually, we know the net book value is the cost minus accumulated depreciation. So we don't have this one. But in our case, we have this revaluation gain. So the revaluation gain, this one we have it in the income statement. Can you go to the income statement down there? In the income statement, you are told the revaluation gain on property was this one. So can you be able to determine the revalued amount? Can you be able to determine this revalued amount? Yes. The revalued amount automatically will be the difference between these two values there. So how much is that? Is it 17 million? Is it 17 million? Because property was revalued to 24 million. We don't have the net book value, but we have the revaluation gain. The revaluation gain, which is this one. Remember, I'm saying to determine the revaluation gain, you take this one, you minus the net book value. So we have this one, we don't have this, and we have this. So how much amount do we less from 24 million to get 7 million? In this case, I'm saying should be 17. Should be what? 17. Is that the position? And Sharon, Dangote, is that the position? Ben, is that the position? Jane, is that the position? Yes. So this is the revalued amount. This is the revalued amount. At the date now, this particular asset were revalued. That was the net book value. That was the net book what? Value. But if you go back to that question, to that point number 2, that is, we are told we are given the cost. We are given the cost of this property. The cost of the property at the date of revaluation. And actually the cost here, we are told it was 25. Remember I said, once an asset has been revalued, you compare its revalued amount or the fair value with the net book value, because we know that this property comprises of land and comprises of buildings. Automatically, buildings are depreciated, but basically land are not being what? Depreciated. Yes. So included in this particular cost is the cost of land. And actually, we are told the cost of land is what? Is 5 million. Is 5 million. So mean that the difference here, which is the 20, this now will be the cost of, this would be the cost of buildings. That would be the cost of what? Of buildings. But basically, we are told at the time these assets were revalued, automatically we are saying that this was their net book value. Yes. So now using this information, there is something I want us to compute. There is something I want us to compute as per note number 2. Let's go to sentence number 3 of note number 2. We are told buildings were being depreciated on a straight line basis at the rate of 2%. 2%, and had a remaining useful life of that year as at the date of revaluation. So basically what that means is that before the company revalued buildings, the company was depreciating buildings, at the rate of 2%, at the rate of what? 2% per annum. This is how the buildings were being depreciated before they were revalued. So after they were revalued, we are told that now the buildings are estimated to have a useful life of 30 years. So basically what that means is that these buildings which were revalued now will be depreciated on a straight line basis, over the next 30 years. Over the next what? 30 years. So the reason why this information is important, we need to be very clear, because I know these require a lot of understanding. So for you to be able to understand what you want to do next year, you need to understand this. Before the buildings were revalued, this before the revaluation, the buildings were depreciated at the rate of 2% per annum. But after revaluation, After revaluation, we are told buildings are estimated now to have a useful life of 30 years. Yes. Now, why do we need to have this information? The reason why we need to have this information is because of the last sentence of that point. So we are told, however, it made an inter-reserve transfer for the excess depreciation upon revaluation. So automatically, the moment the company has revalued a building, its value increases. Its value do what? Increases. And as a result of that, you'll be able to see that the depreciation which was accounted for during the current year for the buildings is more than the previous depreciation which was computed before the buildings was revalued. So let's compute the depreciation before the revaluation, and after revaluation, you see, will the depreciation increase as a result of the buildings being revalued? So for example, before the revaluation, before revaluation, how are the buildings depreciated? The buildings were depreciated at the rate of 2% per annum. And I hope you can see that this 2% per annum is on straight line. So if it is on straight line, it is automatically on cost. What was the cost of buildings before they were revalued? The cost of buildings before they were revalued is this one, which is 20. So if we get 2% of this, I think that one should give us, is it 400? 2% of this? 2% of that will it give us, it's a 400. 400, eh? Yes, 2%, because we do away with 2 zeros, 400. So that is the depreciation before the revaluation. What about after revaluation? After revaluation. Remember, after revaluation, buildings now will be depreciated, used on straight line basis over the next 30 years. So what we need to do, we need to determine what is the revalued amount of buildings. Who can be able to recall the buildings were revalued to an amount of how much? Buildings were revalued to an amount of how much? Remember, the property which comprises of landed buildings was revalued to this one, 24. So tumesema 24 million, because the revalued amount here land ni 6 million, revalued amount here building ngapi ni 18. So meaning after revaluation, we are going to compute the depreciation for buildings based on the revalued amount. The new value of the building is this. So which is basically 18, and then we are going to depreciate this in the next 30 years. In the next 30 years means to get the depreciation per annum, you take the new value, you divide that with 30 years. So this will give us what? This will give us 600. So in this case, now you can see, before the buildings were revalued, the depreciation per annum was 400. After the buildings were revalued upward, the depreciation increases to 600. Now, what is the excess depreciation? What is the excess depreciation? The excess depreciation in this case is the difference here, which is 200. You can see the depreciation increased with how much? With 200. So that is why it was important for you to understand all this. Now, having said, although in an examination setup, to keep a revision, you'll be able to see that all these workings, you don't have to do them in an exam. Basically, we are going to look on some of the shortcuts, which are basically required maybe whenever you are doing these questions, because you can see in an examination setup, you can't be able to do all this. So what I want us to do, I want us to basically move and prepare two accounts here, the PP account and basically the accumulated depreciation account. So let's prepare these two accounts here. So we start with the PP account. And this question here, we will prepare this account at cost. This account will be prepared at cost. Will be prepared at cost. Will be prepared at cost. And then we prepare this other account, the accumulated depreciation account. The reason why we're preparing this account is to compute depreciation for the year. The reason why we're preparing this account is to determine the PP which were acquired. So what do we record in the PP account? So we record the value at the start, and actually remember everything here will be recorded at cost, and then we record the cost at the end of the year. So then on this side, we record any revaluation gain. We record acquisitions. Then on this side, we record disposal. The revaluation what? The revaluation loss. Any revaluation what? Loss. Any revaluation loss? Yes. Then in this account, what do we record? We record the accumulated depreciation at the start. And then on this side, we record the depreciation for the current year, which was taken to the income statement. We record the accumulated depreciation at the end of the current year here, at the end of the current year. And also because there was an item which was disposed, the accumulated depreciation on disposal. The accumulated depreciation on disposal. So we have everything here, the opening balance, the closing balance, this one we have it. So what we want to compute is this. So in this question, we have this, we have this, we have revaluation gain. Automatically, we don't have a loss. We have the item of PP which were disposed. So what we want to determine is that. So let's start with this accounting fact. So we have the opening balances for accumulated depreciation in note 1. The accumulated depreciation in note number 1 at the start, which is the year 2024, is basically 9240. Note number 1, I'm getting that from note 1. The accumulated depreciation at the end, this one, is 10430. Then if you go to note number 3, the motor vehicle which was disposed, remember motor vehicle is part of the PP because these include property, plant and equipment. Property, plant and equipment include all tangible, non-current assets, including buildings, land, motor vehicles. All of them are part of the PP. So the motor vehicle which was disposed in note number 4, we need to record its accumulated depreciation here. So its accumulated depreciation is 800. Is 800. So we get the balancing figure here, which will be what? Which will be what? Will be the depreciation for the current year. Depreciation for the current year. Depreciation for the current year. So 800 plus 10430 minus 9240. So, and basically I'm getting a figure of 1990. 1990. That is what I'm getting there. Confirm whether you're getting the same. So then we need to record the costs at the start, the cost at the end, using the information we have in note number 1. So the cost of PP at the start is 33,400. Remember, I said this account, we are preparing it at cost here. So the cost at the end is 47,900, like that. And then the revaluation gain. Revaluation gain, remember this one, we have it in the income statement. We have it in the income statement. Income statement. So in the income statement, revaluation gain, which is basically 700 here. Yes. And then we also have the disposal. Disposal, this one is what we have in note number 3. The motor vehicle which was disposed in note number 3. And I've said everything in that account will have to be recorded at cost. So the motor vehicle which was disposed in note number 3, we record it here at cost. We record it here at cost. Yes. So what we do, we get the balancing figure which is on the debit side, and that is the PP which were acquired. That is the main objective of preparing that account. What do we have on the credit side? 47,900 plus 2,000 minus what we have on the debit. 33,400 minus 7,000. So in this case, I'm getting 95. 95. Confirm whether you're getting those values so that now we can be able to move and prepare a statement of cash flows. Are you getting those values? If you're getting those values, you confirm. You confirm whether you're getting those values. Yes, are you getting those values? Dagote and Sharon. Ama swali imekuwa ngumu. Yes, I know this question is a challenging one, but it's a very good question. If you understand it, it's a very good question. It's a very good question on the statement of cash flows. It's a very good question. Juma, are you getting that? Are you getting those values? Are you getting those values? Are you getting those values? I will presume yes. Yes. So I think now we can be able to move and we prepare our statement of cash flows. But even before we look on we prepare the statement of cash flows, someone may ask, how is this excess depreciation accounted for? This excess depreciation. Now, this excess depreciation, the double entry for this is usually debited debited in the account which is called the retained earnings. Is it the retained earnings? No. This one, in other terms, let me put it like this instead of giving a double entry. This one, excess depreciation, this is deducted from the revaluation gain. You see, the reason why there was excess depreciation is because the assets were revalued upward. So this one is basically deducted from the revaluation gain. If, for example, you go to a balance sheet, to a statement for financial position under equity, can you go to the statement for financial position under equity? Under equity, can you see we have something called the revaluation reserve? Under equity, can you see something called the revaluation reserve? The revaluation reserve is an amount of how much? Jane? Revaluation reserve, which is under equity. Who can be able to see the revaluation reserve? It is 68. But, and actually you can see at the start it was 0. So what we know is that revaluation reserve basically arises from this revaluation gain. Can you remember the revaluation gain? The revaluation gain was 700. But I hope you can see the amount which was transferred to the revaluation reserve account is 68 instead of this one. So now this excess depreciation number 1 is deducted from this. That's why you can see the amount taken to the revaluation reserve is 68. So this one is deducted from this revaluation gain. And then number 2, it is added to the retained earnings. It is added to the retained what? Earnings. And therefore, when computing the dividends, remember the other question we did, we were computing the dividends paid using the retained earnings. So when computing the dividends paid using the retained earnings, we must remember to capture this. So tutachukua retained earnings at the start of the year, and then we will add this amount of 200. Sasa? Yes, because this excess depreciation is how it is accounted for. It is deducted from this revaluation gain. It is then added to the retained earnings. Sasa? Yes. So when computing the dividend paid, lazima tukumbuke hiyo amount ya 200 to add it to the retained earnings at the start. Sasa? Yes. So having that, let's move and prepare a statement of cash flows as required by the examiner. So the name of the company is 𝐕𝐎𝐈𝐍 Limited. And basically this is a statement of cash flows. A statement of cash flows, which is for the year which ended 31st of October 2025. A very good question on cash flows. Very, very good question on cash flows. Yes, so remember here we said we start by determining the cash flows from operating activities. We need to have 2 columns here. And basically our figures are in thousands of shillings. Our figures are in thousands of shillings. Are in thousands of shillings like that. So when computing this, we said always start with the profit before tax. Not before tax. Yes, the profit before tax. Always. The profit before tax is an amount of 2880. 2880. Remember, we get this from the income statement, profit before tax, and then we make a number of adjustment to this profit. And we say the first adjustment to be made to this profit should be to add back the finance cost, such that we have the profit before interest and tax. So the finance cost is just above that profit. I hope you can see it somewhere. Can you see that profit somewhere, Ben? Vanessa, can you be able to see that profit somewhere? Not profit, rather. Can you be able to see that finance cost somewhere in the income statement? Can you be able to see that? Jacqueline, can you be able to see that finance cost? Yes, it is 1,000. It is 1,000. So basically, after adding it, we have now the profit before interest and tax. Then from there, we said we need to make a number of adjustments to this profit. And actually, we said, first of all, we adjust our profit with the non-cash items. So we said just recall that acronym, 𝐷. So this one stands for depreciation. Depreciation on what? Property, plant and equipment. This one stands for impairment loss. Impairment loss on goodwill. So actually in this question, we don't have this. This one stands for amortization of intangible assets. Equally in this question, if you check on what we have under the non-current assets, under the non-current asset in our balance sheet, we don't have intangible assets. Equally, we don't have this. This one stands for loss on disposal. Do we have the loss on disposal? Yes. Working 2. We have a loss on disposal of 180. We record it here. And remember, you said that these 4 items should be added, but the gain should be deducted. So then this stands for gain on disposal. Do we have a gain on disposal? No. So we don't have this. We have this. We don't have amortization. We don't have impairment loss, but we have depreciation. Depreciation is what we have computed here. This one, 1990. 19 what? 1990. So that's basically what we have. Then in this income statement, can we go to the income statement which we have? In the income statement, just above this profit, there is something called investment income. Now, this investment income, we are told there are dividends which were received. Automatically, these dividends which were received, I hope you can be able to recall our company has invested in shares. This investment in shares. So the company, as a result of having invested in shares, it is receiving some dividends. Now, this dividends or this investment income, we said this one is not an income from operating activities. This one is an income generated by the company from where? From investing. So take into account that income is already included here. We need to deduct it. Investment income. Why are we deducting it? Is because this is not an income generated by the company from what? From operation. This is an income generated by the company from what? From investment. So this one will be considered when computing the cash flow from investing activities. Remember, these are dividends received. We less them here. Yes. And I think we get the net amount. So that then we proceed and we make the adjustment for changes in working capital. So let's get the net amount. So we will take 2880 plus 1000 plus 1990 plus 180 minus 150, and I'm getting 5900. I'm getting 5900. I'm getting 5900. 5900. I'm getting 5900. Is that what you're getting? 5900? Are you getting 5900 there? Are you getting 5900? Are you getting 5900? Yes. So then next we need to consider what? Next we need to consider something called the changes in working capital. Next we consider changes in what? Changes in working capital. And basically we said that if you come across a question for cash flow, make sure you get these marks. Because here we said you just consider 3 items. 3 items. You just need to record that acronym. RIP, not less in P's, but receivables, inventory, and payables. So receivables, inventory, and who? And payables. Then this formula here, opening minus closing. Opening minus closing, and then closing minus opening. As simple as that. Now, let's go to where we have current assets. In our statement of financial position, we consider, first of all, the receivables. The receivables, you take the opening balance. Opening balance is the value we have in 2024. Closing balance is the value we have in 2025. Receivables at the start is 5590 minus the closing, which is basically 65, which will give us negative 910. Write it there as a negative, is a cash outflow. We do the same for inventory, still add the current assets. So opening inventory, which is 6880, minus closing, which is basically 9580. We have negative 27, which is still a cash outflow. I hope you're getting those values. And then we go to where we have current liabilities. Current liabilities, we consider the payables. Payables, we use that formula, closing minus opening. Closing is 3640 minus opening, which is 31. And basically, I'm getting positive 540. So you can see these marks are quite free, or these are basically free marks. And that's why I said, if you happen to come across a question for cash flow, make sure you get those marks there. Make sure you get those marks there. So having that, I think we can get the net amount 59 minus 910 minus 2700 plus 540. So that will give us 28, 30, 28, 30, 28, 30, 28, 30. I need to create some space here. So I will do away with this. So I hope you already have this. So the bonus issue here was the bonus issue, not the bonus issue share premium, 4,000. And the shares which were issued for cash, 16,000. So that's basically what we need to have from these two accounts here. So I need to do away with this. Yes, so in that case, we are getting a net amount there of what? A net amount there of 2830. And then to this, we said we less two items. Number one, we less the interest all finance cost which was paid, interest all finance cost paid, and also we less tax paid. I think we can start by computing this one. For the interest paid, we said we check two items. The interest or the finance cost from the income statement, this one, which is 1,000, and then you go back to your balance sheet, specifically under the current liabilities. Current liabilities, you check whether there is any accrued interest. Do we have any accrued interest under the current liabilities? Do we have any accrued interest? Automatically, no. Ama tuko nayo, Dagote? Do we have any accrued interest under the current liabilities? No, we don't have any. So, but in this case, we said if there was any accrued interest, what you do, take the accrued interest at the start, or the interest payable at the start, which we don't have, plus the finance cost in the income statement, which is this one, 1,000, which is basically 1,000 minus the accrued interest at the end. So the difference, or basically whatever you get, is the interest which was paid. We do the same for tax, but we say for tax, usually in the balance sheet, we have two components of taxes. Under the non-current liabilities, under the current liabilities. So under the non-current liabilities, we have deferred tax. These are tax to be paid by the company in the future. And the current tax under the current liabilities, these are tax to be paid within the next 1 year. So how do we compute that? We say the approach is the same. Though here now we have two components of taxes in our balance sheet. So we take, first of all, can we go to where we have non-current liabilities? And I want you to understand this because you'll come across this in all questions for cash flow. So the deferred tax at the start is 960. So at the start. And then to this, we also add the current tax at the start under the current liabilities. Under the current liabilities, the tax which are not being paid before 90. So then to this, just like what you have done for the interest, we take the tax from the income statement. The tax from the income statement, you can be able to see the tax for the current year from the income statement. The tax for the current year, we can be able to see that is an amount of 940 from the income statement. Then to this, we less the taxes which are not being paid at the end. First of all, we go to where we have non-current liabilities. The deferred tax at the end was 880, and under the current liabilities, the current tax not yet paid was 620. That is how we compute the tax paid, and we use the same approach even in the other question. Even in the other question, we compute the tax paid. So we have 960 plus 490 plus 940 minus 880 minus 620. So this basically will give us what? 890. So basically this is what? This is the tax which was paid. So having that, we move and basically we get the net cash flows from operating activities. Net cash flows from what? Operating activity. So we need to work out that. So we have 2830 minus 1,000 minus 890. So basically this one will give us what? Will give us 940. The net cash flow from what? From operating activity. So next, we determine the net cash flow from investing activities, or basically we determine the cash flow from investing activities, cash flows from investing activities, Now, what do we consider here? Number one, asset which were acquired. Number two, asset which was disposed or sold. And number three, any income generated from investment. That is basically what we consider here. And I think we have everything which is required here. I think we can start with this investment income in the income statement. This we said is an income generated from investing activities. So we have investment income, which is basically an amount of 150. And this one here it is considered as an inflow. Remember, this money which was received by the company from investing. So these are cash received from investing. So what else do we consider here? In note number 3, there was disposal of motor vehicle. Note number 3, and remember in this case we said what we consider here is the sales profit. How much amount was received from selling that motor vehicle? As per note number 3, it was 1020. This 1020 is still a cash inflow. Is still what? A cash inflow. Now, still, as per the information we have in note number 4, we have this investment in equity instrument which was acquired. In other terms, we have these shares which were bought by the company during the current year. So we talk over investment in equity instrument. So these are shares which were acquired. This is an investing activity. So we consider the cash which was paid, this one, which is 11,500. And this one is a cash outflow. Being a cash outflow, recorded there as a negative. Then, from this account which you have prepared there, the PP account, we have determined that there were some PP which were acquired at a cost of 95. So we have PP which were acquired. At a cost of 95. I don't think we have anything else here. So basically what we need to do is we determine the net cash flow from investing activities. So we have 150 plus 1020 minus 11,500 minus 95. So the net cash flow from investing activities is 19,830. Is that what you're getting? Yes. So then next, we determine the net cash flow from financing activities. Recall, we say that all the items which we record here, we basically get them from equity and the non-current liability section. So you just go to your balance sheet, your statement of financial position, at the equity and also at the non-current liabilities. That is basically where you get the items to be included here. Can we do that? So we start with the equity section. At the equity, the first item, the first two items, we have done some workings for that. Ordinary share capital, share premium. So we have said what we consider here are the shares which were issued for cash and the share premium which was received in cash. And I think we have already computed that from the two accounts we had prepared here, the share capital and the share premium. So we will say there was issue of ordinary shares. And basically we consider the shares which were issued for cash. And I think from our share capital account, 16,000. So these are shares issued for cash. We consider that here. And then we also consider the increase in share premium. So the amount of share premium which was received in cash, which is from the share premium account, 4,000. Forward, 4,000. So basically, from at the equity, I think we have dealt with those two items. Then below share premium, we have revaluation reserve. Do we consider that here? No. We say that arises from the revaluation of assets. Revaluation gain is a non-cash item. We don't consider that here. Below that, we have financial asset reserves. Equally, we have said it is the increase in the market value of these shares. This one is also a revaluation gain. A revaluation gain is still an non-cash item. Don't consider that here. Once the market value of an investment increases, no cash which is received from that is a non-cash item. Don't consider that here. So then from there we have the retained earnings. Remember these retained earnings, we use it in computing what? The dividends paid. And I think I gave you a formula for computing this. We said we take the retained earnings at the start plus profit after tax minus the retained earnings at the end. That is the formula. But in this case, we have said that there was an excess depreciation. That excess depreciation of 200, I hope you can remember that. We have said it should be added to the retained earnings at the start, because we have said that excess depreciation should be deducted from the revaluation gain. This one, the revaluation gain we had of 7,000, and then added to the retained earnings. So therefore, let's compute the dividends which were paid. I will take the retained earnings at the start, which is other equity, which is basically 2350. Even before I add this, I must add the 200, excess depreciation. Excess what? Depreciation. And then I add the profit after tax. The profit after tax, I get this from the income statement. From the income statement up there, the profit after tax is the same with the profit for the year. 1940. And then minus the retained earnings at the end, which is basically 40/40. Which is what? 40/40. Yes, so you can see this one was a little bit tricky because of this concept of excess what? Depreciation. You needed to compute that. So 2350 plus the 200 plus the 1940 minus 40/40. So basically I'm getting dividends paid off for 50. Remember, dividends paid is a cash outflow. So record this as a negative. So we are done with all items of equity. Sasa, we got to non-current liabilities. Non-current liabilities, how many items do we have there? 2. So we are only considering 1 because deferred tax is used in the computation of this. So we are only considering 12.5% loan notes. And those 12.5% loan notes, you can see we have an increase in the value. So what causes the value for this 12.5% loan notes to increase? Their value increases because the company issued additional 12.5% loan notes. So if the company issued loan notes, the company receives some cash. So here we will say there was issue of 12.5% loan notes. So which is equal to the increase. So how much is that increase? Is it 800? Is the increase 800? The increase, is it 800? Is the increase 800? Increase in 12.5% loan notes. At the start 76, at the end 84. Yes, we have an increase of 800. So that is caused by issue. That's that? Yes. So we are done. So what we need to do is to get the net cash flow from financing. So we have 16,000 plus 4,000 minus 450 plus 800. So this gives us 20,350. And then now from there we get the net changes in cash and cash equivalents. How do we get that? We said we need to add 3 cash flows. We need to add the net cash flow from operating, the net cash flow from investing, and the net cash flow from financing. So these 3 cash flows, this, that, and that. So let's add that. We have 940 minus 19,830 plus 20,350. And basically that will give us what? 1460. 14 what? 60. Then to this, what do we add? We add the cash and cash equivalents at the start. The cash and cash equivalent at the start. So this cash and cash equivalent at the start, we have it in our balance sheet at the current assets. So how much is the cash and cash equivalent at the start? Cash and cash equivalent at the start. Who can see that? Yes, the cash and cash equivalent at the start is 18 what? Is 1870. So after adding the two, we should get the cash and cash equivalent at the end. The cash and cash equivalent at the end. The cash and cash equivalent at the end. Cash and cash equivalent at the end. And how much is that? That one is basically how much? That is plus 1870. And basically that will give us what? That one will give us 33. That. So this 33 that we said, it should always reconcile with the value we have in our statement of financial position. Are the two values reconciling? Are the two values the same? 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 Yes, the two values are the same. The two values are the same. So it basically means that we are 100% correct.
Talking about adjusted present value. We were talking about adjusted present value. The concept of adjusted present value. And adjusted present value. And we said, under adjusted present value, this is whereby we compute the NPV of a given project, not using the weighted average cost of capital, but the cost of equity. So here we say we compute the base NPV using what? The cost of equity as the discount rate, as opposed to the NPV method, which uses the weighted average cost of capital. Then after computing the base NPV using the cost of equity, we make adjustments. That is, we adjust this basic NPV with what? Number one, present value of interest tax shield, with present value of interest tax shield. Next, with present value of issuing costs, equity issuing costs. That is flotation cost in short. Flotation costs. Let's say flotation cost. Then we do present value of debt issuing costs, which is again also the flotation, or rather, yeah, the flotation cost of debt capital. That is, we adjust this NPV. So here we said, for the base NPV, that figure here, we add the present value of interest tax shield, but we deduct these two, present value of equity issuing costs and the present value of debt issuing costs. Then we said further, that these two are in present value terms. These two are in present value terms because they are issued at the beginning of the project's life, which is today. Then we said for you to determine the interest payable, this will depend on the amount of loan payable. So we want us to have an illustration on this. So take note, for you to compute the adjusted NPV or under the adjusted present value, you need a base NPV. After getting the base NPV using the cost of equity, then you do the adjustments. We only have 3 adjustments. That is the present value of interest tax shield, which is based on the amount of interest payable on the loan. Then present value of issuing cost of the equity, present value of issuing cost of debt capital. So let's have an illustration. Let's look at the illustration in the handout. Let's look at the illustration in the handout, please. If you're there in the handout, kindly let me know. We're looking at the illustration just under adjusted present value, under the adjusted present value. Are you there? Kindly confirm you're there so that we can proceed. Okay, fine. That it's the question on blades limited from the handout. Blades limited from the handout. That is the question that we want to. So I want us to move very fast because these are not technical issues. These are the things that you can easily understand. So the question says, Blades Limited is considering diversifying its operations away from its main areas of business, food manufacturing. So these people, and I said, always ensure you understand the context of the question. Just get the story first. Get the story first. If you get the story first, then it becomes very easy for you to understand what? The calculations, and also for you to get the concept. So try to understand the story that we are being given here. So Blades Limited is considering diversifying its operations away from its main areas of business, food manufacturing. So currently they are in food manufacturing, into the plastic business, and they want to venture in the plastic business. The company wishes to evaluate an investment project which involves acquisition of a molding machine that costs shillings 450 million. So the company wishes to evaluate an investment project which involves acquisition of a molding machine that costs shillings 450 million. The project is expected to produce net annual operating cash flows of shillings 220 million for each of the 3 years of its useful life. The project is expected to produce net annual operating cash flows of 220 million for each of the 3 years of its useful life. Its salvage value is 0. The assets of the project will support debt finance. The assets of the project will support debt finance of 40% of its initial costs, including issuing costs. So we are saying that that 450 million will be formed by 40%. 40% will come from our debt. The loan is to be repaid in 3 equal annual installments. Equal annual installments. The balance of the finance will be provided by planning of new equity. Issue costs will be 5% for the equity and 2% for the loan. So the issue costs we've been given there. Debt issue costs are allowable for tax. Debt issue costs are allowable for tax. Then the plastic industry has an average equity beta of 1.368 and an average debt to equity ratio of 1:5 at market values. Blades Limited's current equity beta is 1.8 and 20% of its long-term capital is represented by debt, which is generally regarded to be risk-free. The risk-free rate is 10% per annum, and the expected return on an average market portfolio is 15%. Corporate tax is at 30%. The machine will attract a 70% initial capital allowance, and the balance will be written off evenly over the remainder of the asset's life and will be allowable against tax. The firm is certain that it will earn sufficient profits against which to offset these balances. When required, using an adjusted net present value, advise whether or not the project is worthwhile. So using adjusted net present value. So now, using the net adjusted present value, to start with, we are supposed to compute what? The base NPV. So the base NPV is just, you just compute the normal NPV of the project, but this time round, using the cost of equity. So we'll start, so write step one. We are going to do it in steps. So step one, compute the cost of equity of the company. Compute the cost of equity of the company using CAPM. Compute the cost of equity of the company using CAPM. Compute the cost of equity of the company using CAPM, Capital Asset Pricing Model. So here we start with the cost of equity. So step one, cost of equity. Cost of equity, Cost of equity. Now, if the cost of equity was given, we would not have computed. So we would just have gone to step number 2. So we are using this formula. We're using this formula to get the cost of equity. We're using this formula, the CAPM formula. So risk-free rate has been given. Risk-free rate is what? we are told the risk-free rate is 10%, and the return on market portfolio is 15%. Return on market portfolio is 15%. Then beta of equity, we don't know. Beta of equity, we are going to look at that. I want us to go back to the point where we are talking about betas. The paragraph where we are talking about the betas, that should be the last paragraph, where they're saying the plastics industry has an average equity beta of 1.368. 1.368. Remember, this company, Blades Limited, they are currently in the food manufacturing industry, but now they want to venture in the business, the plastic business, And now we want the cost of equity that will be relevant to evaluate a project in the plastics industry. So one thing that you're supposed to note is that the relevant beta is the beta that relates to the plastics industry, because that is the industry that we are venturing in. We said beta represents the market risk in a certain industry or sector. So here, for us to compute the cost of equity that is relevant to evaluate this particular project, we need to get the beta of equity that relates to the plastics industry. So the relevant beta here is 1.368. The plastics industry has an average equity beta of 1.368. So forget about the beta in the food processing, on the food manufacturing. And again, at an average debt to equity ratio of 1:5. Debt to equity ratio is 1:5 at market values. Now, the most important thing here to note is that the question tells us that Blades Limited, they want to finance using 40% equity and how much? 60% equity. Because if you go back there, up there, there is a statement that says, what? There is a statement which says, paragraph 2, the assets of the project will support debt finance of 40% of its initial cost. So we are going to have 40% as debt, 60% then will be equity. But note, if you look at the debt to equity ratio of plastic industry, in the plastics industry, debt to equity ratio in plastics industry is equals to 1:5. So this beta of equity in the plastics industry, let's say this, say plastics industry. I want us to analyze this so that you can understand. Plastics industry is saying beta of equity in this company, and this beta is levered. This beta is levered. The levered beta in the plastics industry is 1.368. 1.368. Then debt to equity ratio is equals to 1:5. Is equals to 1:5. So this beta of 1.368 is geared using this ratio. So if we were to rewrite this, this would be what? 1:5. 1:5. If we write this into fractions, it will be debt will be 1/1 plus 5. Is it 1:5? Sorry. 1:5. So we are saying, 1:5. 1 plus 5. Then equity should be 5/1 plus 6. 1 plus 5. Exactly. So this is 1/6. So debt, okay, let's have it here. let's have it here. 5. Okay, just a minute. Let's just get this 1 over 6. So definitely this will be 5 over 6. So 5 over 6, yeah. So it's 5 over 1 plus 5, which is equals to 5 over 6. 5 over 6. Get this in decimal places. Get this in decimal points now. And you try to hurry up. Okay, yeah. But this is not even that important, but just get it. 0.17, 0.17, and 0.1.7, 0.83, yeah. 83. So that is how you get the fractions from this. But now, what is my point? My point is, this is what we have in the plastics industry as debts and equity. But this is what we have in Blades Limited. This is how Blades Limited wants to finance their project. This is what we have in the plastics industry. So it does not mean that if you go into a certain industry, you must adopt the financing model that is there. No. What you can only adopt from that industry, it is the beta, because you cannot change the market conditions. You cannot change the market risk, but you can adopt your style of financing. So what you want to do now, well, the reason why we've been given this information is we are supposed to ungear. We are supposed to ungear this beta. We are supposed to ungear this beta using these weights and regear it using the Blades Limited weights, using the Blades Limited weights. So maybe you can put a note somewhere and say, that is not step number 2, just a note say, the relevant beta of equity, the relevant beta of equity is the plastics industry beta, is the plastics industry beta. Full stop and say, ungear the beta using the debt equity ratio, ungear the beta using the debt equity ratio in plastics industry, ungear the beta using the debt to equity ratio in plastics industry, and then regear, using Blades Limited, and then regear using Blades Limited capital structure. Blades Limited capital structure, or into brackets, financing model. No, so let's now ungear the beta. So you are aware, you know how we ungear the beta. Eh? So if a beta is geared, we said to ungear the beta, you get the equity, you divide by E plus D 1 minus T. That is how we ungear. So this one, beta of the ungeared beta will be 1.368 times 0.83 over 0.83 plus, okay, we can still use 5. We can still use 5 and 1. 1 minus 0.3. Kindly get the beta. Get that beta. How much are you getting? Hey, my people, I think yours is wrong. If I'm not wrong, you're wrong. I'm getting 1.196. This is what I'm getting. This is what I'm getting. 1.196. Yeah, Diana almost there. But okay, someone else? Hey, you people, why this? Why these differences? Because what are you doing? Just get 0.83, 0.83, you divide 0.83, you divide by into brackets 0.83 plus 0.17 times 0.3, close the brackets. So I think mine is okay. I don't know why I feel mine is okay. We proceed with mine, 1.965. Yeah, that is with some. Let's proceed. Or you can say, let's try this. 1.368 times 5 over 5 plus 1 minus 0.3. I think this one would be better for majority of us. So we divide 5 plus 1 times 0.7, close the bracket, times 1.368. Here you'll get 1.2, which is almost the same as what we have here. Yeah. If you round off this, you are getting 1.2. So now we regear. We regear, and we say to regear, now we use the weights of the current company. So here we say this 1 times D, 1 minus T over E. So we are using this one. So this will be 1.196. This is what we are gearing, because this is the ungeared beta, times into brackets 1 times 0.17 times 1 minus 0.3 over E, 0.83. Or let's use 1.2. Let us use 1.2. Let us use 1.2 for consistency. You can either use 5 here, 1 and 5. Just use what you want to use. So this will be, this is plus, sorry, this is plus, is it? This must be plus. This is plus. So this is where people get wrong with these formulas. Instead of adding, maybe you're multiplying, something like that. So this is 0.17 times, or let me use 1, 0.17 times 0.7, you divide by 0.83, you add 1, then you multiply by 1.2. I'm getting 1.37. 1.37. 1.37. Now let us regear now. Oh, no. We have now the regeared beta. We have the regeared beta. Let us get the cost of equity. Cost of equity is equals to 10 plus into brackets 15 minus 10 times 1.37 times 1.37. The cost of equity of Blades Limited. I'm getting 16.85. 16.85%. Now we have the cost of equity. That was the first step, computing the cost of equity. So we go to step number 2. Step number 2 say compute the base NPV. Compute the base. Compute the base NPV. Compute the base NPV using the cost of equity computed above. Compute the base NPV using the cost of equity computed above. Using the cost of equity computed above. So let's get the cost of, let's compute the base NPV. I'm going to do away with this. Kindly, if you have not written, you can screenshot. If you have not written, you can screenshot. Okay, fine. So to compute the NPV, we are just computing normally. So we start with the year. The project has a useful life of 4 years. So here we have 0. Let's start with year 0. 1, 2, 3, and 4. So the initial cost is for 50 million. Initial cost of the project is for 50 million, which is negative. That is what the question says, that the company wishes to evaluate an investment project which involves acquisition of a molding machine that costs shillings for 50 million. Then the project is expected to produce net annual operating cash flows of 220. So we have annual operating cash flows, annual cash flows. So these are earnings before depreciation and tax. Earnings before depreciation and tax, 220 million. So we have 220, 220, 220, 220. Then next, let us tax. We less tax. We less tax. Tax is 30%. Tax is 30%. So 30% of this should be 66. Is it? Should be 66. If I'm not wrong. $66. Next, we want depreciation tax shield. Depreciation tax shield. DTS. Let me write DTS. If you know you are going to forget, kindly write in full depreciation tax shield. depreciation tax shield. And the question says, let's go back to the question. The point where they are talking about depreciation, that should be in the last paragraph. The risk-free rate is 10% per annum, and the expected return on an average market portfolio is 15%. Corporate tax is at 30%. Corporate tax is at 30%. The machine will attract a 70% initial capital allowance, and the balance will be written off evenly over the remainder of the asset's life. So capital allowances is what we are calling depreciation. So here, say capital allowances stroke depreciation. Year one, now let's say depreciation tax shield. Depreciation tax shield for year one is equals to 70% times 450 million times 30%. So remember, depreciation tax shield is equals to depreciation times the tax rate. So here they are claiming 70% of the cost of this asset as capital allowances in year one. So that's why we're saying 70% of 450 times 30%. So how much are you getting? How much are you getting as the depreciation tax shield? 94.5. 94.5. So this is a saving. It is the tax advantage that we are enjoying. So 94.5 here. Then the last one they're saying, the machine will attract a 70% initial capital allowance, and the balance will be written off evenly over the remainder of the asset's life. So the remainder, it's 10, 10, 10. So year two, it will be 10% times 450 times 30%. Year three, it will be 10% times 450 times 30%. And the last one, year four, it's the same, 10% times 450 times 30%. 13.5, 13.5, 13.5. So you add 13.5. And you get the after-tax cash flows. You get the after-tax cash flows. Where are we getting 10? Where are we getting 10? 100 minus 70 for year one, the balance is 30%. 30% you divide by 3, you will get 10, 10, 10, 10. Douglas, is that okay? 70%, yeah. 100 minus 70% for year one, the balance is 30%. You divide by 3 because they're saying it will be distributed evenly over the remaining useful life. Now let's get this. So net cash flows. This is 450 negative. Then the others. But let me ask, what is the useful life of the project? Is it 4 years or 3 years? Should be 3 years. Should be 3 years. The company wishes to evaluate an investment project which involves acquisition of a molding machine that costs 450 to 20 for each of the 3 years. Hey, it's 3 years. Sorry for that. It's 3 years. So, so this now will change to 15. This 10 that we are talking about here will change to 15. This one is now 15, not 10. It's 3 years, 15. Kindly make that adjustment. Make that adjustment. The useful life of the project is 3 years. $20.25. Okay. 20.25. The year one will not be affected. 20.5 or 25. So let's get the cash flows. We have 220 minus 66 minus 66 plus 94.5. This is 248.5. Should be not the same. 220 minus 66 plus 20.25. 174.25. 174.25. 174.25. So we have the cash flows. Let's compute the NPV. So this is 20.25. 20.25. Is that okay? Now we want to get the NPV. Okay, let's just get the NPV here. Let's get the discount factor. Discount factor here. Discount factor. And we're using 16.85%. That is where now you apply this formula. Because 16.85 is not in the tables. Alternatively, you can round off to 17%, but the best thing is to do this. So get this. So for year one, you will say at what point are we supposed to use 4 years or 3 years? We are not supposed to use 4 years at all. Or is there a point they have talked about 4 years? It's just a mistake that we had made. They are saying the useful life is 3 years. Fred, we are saying the question says the useful life is 3 years. I don't think they have mentioned 4 somewhere, 4 years anywhere, unless I'm not getting your question right. Fred, I want you to respond so that we can proceed. In the meantime, the others get these factors. Get these factors. No, it cannot be 0. Oh, yeah. This formula is misleading. We should have, oh, this is not an annuity. This is a lump sum. This is a lump sum. It's 1 plus r power negative n. 1 plus 0.1685 power negative 1. Then you get the rest. So yours, Douglas, could be correct. 0.8558. Douglas, have you done it this way? 8558. Then year 2. Year 2. 7324. So kindly make that change. The first formula was for annuities. 6268. 6268. So get these figures. Let me also calculate. So 248.5 times 0.8558, 212. This is 212.67. Then the other one, 174.25 times 0.7324. 127.62. Then the other one should 174.25 times 0.6268. 109.22. So the base NPV should be negative 450 plus 212.67 plus 127.62 plus 109.22. Are you getting negative? Negative 0.49 million. So that is the base NPV. Now we are not done. We are not done. We are supposed now to get the adjustments. We are supposed to adjust this figure. We are supposed to adjust this figure with present value of interest tax shield and the present value of issuing costs. So let's go back to the question. We want to know the amount borrowed. Step number 3 now. Step number three say prepare a loan amortization schedule. Prepare a loan amortization schedule. Prepare a loan amortization schedule to ascertain the amount of interest payable. Prepare a loan amortization schedule to ascertain the amount of interest payable per year. The amount of interest payable per year. The amount of interest payable per year. Now, I want to wrap this. Kindly. The base NPV you have said is negative 0.49 million. So I want to wrap this so that we can compute we can prepare the loan amortization schedule. And I believe you've all done this. If you have not, kindly take a screenshot. Kindly take a screenshot so that we can move on. Okay, fine. So why are we preparing the loan amortization schedule? Because we want to know the amount of interest payable per annum. So here it's loan amortization schedule. Loan amortization. So the loan is payable amount borrowed. We start with the amount borrowed. Or loan amount. Loan amount. That is where the problem is. If we get the loan amount, we'll be good to go. So the loan amount is how much? How much was borrowed? Let's go back to the question. The question says, paragraph 2. The assets of the project will support debt finance of 40% of its initial costs including issue costs. Including issue costs. The loan is to be repaid in 3 equal installments. The balance of the finance will be provided by planning of new equity. Issue cost will be 5% for the equity and 2% for the loan. So we want to compute the amount borrowed, and we're so told that 40% of the 450 will come from debt, including the issuing cost. So here, debt, let's start with debt amount. Debt is 40% of 450. 40% of 450 is what we are going to borrow. This is how much? $180. Equity, 60% times 450. That will be $270. Around 270. These are millions. Issuing cost on debt, we are told 2%. 2% times 180. Issuing cost on equity, 5% times 180. No, 270. So 2% of 180 must be 3.6. Now, just a minute. There is a point that you're likely to get wrong. Let's go back to the question. The question says 40% including issuing costs. So this 40% must include the proportion for 180, must include 180 plus issuing costs. That means this is not going to work. This will not work. Because with the issuing costs are, just a minute. Sorry for that. This 180 that you've seen here, this 180 is at 98%. 180 million is at 98% because 2% is the issuing cost. Debt, that is for debt. So here, let's say debt issuing cost. This question can debt issuing cost is, we are saying 180 million is 98%. How about 2%? Because these two should give us 40%. So this will be 180 million times 2 over 98 over 98. Then equity issuing costs will be 270 million is equivalent to 95% because the issuing costs are 5%. How about 5%? Because these two should give us 60%. So this is X. So 270 times 5 over 95. So get that. 3.6. Yeah, 3.674 734. Then 3. The other one 14.21. I want to believe you've understood what you're saying. So what you're saying is that we have the initial costs for 50 million plus issuing costs. Then those two, 40% should be debt, 60% should be equity. 60% should be equity. So that is what we should have. That is what you're supposed to do. So amount borrowed now, it is this 180 plus the issuing costs. So amount borrowed is equals to 180 million plus 3.6734 million. So that should be 183.6734 million. Now we want to compute the installment. It's 0. What? Which is okay, fine. So 183 is okay. Eh? So this 14.21 is okay. Okay, fine. Let's continue. So we're saying the total amount borrowed is 183. That is the loan amount. The loan amount. We want to get the installment. Installment, we say present value of annuity is equals to the annuity times present value interest factor R% power n. The present value of annuity is the loan amount. This is the loan amount. This is the installment. And this is the annuity factor from tables. So here we will say 183.6734. Remember, we want to get the installment is equals to installment times present value interest factor annuity debt. They are borrowing at what cost? At the risk-free rate. That should be 10%. That should be 10%. 10% power 3. Because they are paying in 3 equal installments. They are paying in 3 equal installments. So you divide both sides by present value interest factor, 10% power 3, present value interest factor, 10% at period 3. So installment get the installment. Because we are supposed to divide, what is the factor? 10% for annuities at period 3. 10% for annuities at period 3 should be 10%, 2.4869. This one, 2.4869. 2.4869. No. We are saying period what? 1, 2, 3. Yeah, that's okay. That's okay. 2.4869. That is what we are dividing here by. So we divide 183.6734 divide by 2.4869. Are you getting 73? 73 point. The installment is 73.85. So how many decimal? Let's have 4. 8564. 8564. That is the installment amount. 8578. I'm getting 8564. Another person? Now, loan amortization schedule. Loan amortization schedule. We have here 1, 2, 3. Balance brought forward. It's the amount borrowed, 183.6734. Here we will charge interest at 10%. Then here we will have our installment. And here we will have balance carried forward. So let's charge interest. Let's charge interest at 10%. So 10% of 183.6734, it's 18.3673. So 73.8564. 73.8564. 73.8564. So let give them, okay, I don't know where. This is A, this is B, this is C. So this is A plus B minus C. So let's have that. 183.6734 plus 18.3673 minus 73.8564. 8564. That is 128.1843. 1843. That is what we bring forward here. 128.1843. Charge interest at 10%. This will be 12.8184. Then we charge interest 1843 plus 12.8184 minus 73.8564. We get 67 here. 67.1463. So here 67.1463. You charge interest at 10%. This will be 6.7146. Here we are supposed to get 0. Unless you are wrong somewhere. 67.1463. It's 73 minus 73.8564. Yeah, 0, So we are right. Now, this is all what we wanted. You can imagine. This is all what we wanted from that calculation. Because this is what will give us the tax shield. That is what will give us the tax shield. So let's compute the tax shield here. Present, hey, we also need the present value of interest tax shield. Hey, this question. So we get the tax shield, then we do what? So just allow me to wrap this part. Allow me to wrap this part kindly. Are you done with this part? You can take a screenshot if you're not. You can take a screenshot if you're not done with that part. Okay, fine. What do we want? We want to compute the present value of interest tax shield. We want to compute the present value of interest tax shield. Let's start with year 1, 2, and 3. Interest amount, it's these figures here. 18.3673, 12.8184, 6.7146. 7146. Then we have what here? Tax rate is 30%. Tax shield, which is times 30%. Times 30%, we get the tax shield. Yes, and it's, yeah, the time is still 3 hours. No additional. But I would not advise you to start with such a question. This should be a last question. 0.5.510. Let's have the figures in 3 decimal. Oh, okay, let's be consistent. Let's have 4 decimal places. Let's be consistent. Let's have 4 decimal places. 12.84. 12.8184 times 0.3. This is 3.8455. Next, 6.7146 times 0.3, 2.0144. That is tax shield. Then present value interest factor. We want to get the present value now. Remember we said present value of interest tax shield. Present value of interest tax shield. We are discounting at 10%. here. This is 10%. So this is 0. At 10%, this is 0.9091. This is 0.8264. This is 0.7513. I don't know. Can check. 991, 8264, 7513. Yeah, that's okay. So present values now here. $5.5012 times 9091. This is 5.0093. Let's maintain our 4 decimal places. 8455 times 0.8264. 3.1779. 2.1, 2.0144 times 0.7513, 1.5134. So then total is 50093 plus 3.1779 plus 1.5134. 1.5134. So this is 9.7006. That is the present value of interest tax shield. You can imagine all those calculations that we've done. That is what we wanted. So let's now adjust. Let's now do the adjusted NPV. Let's adjust the NPV. Adjusted NPV. Adjusted NPV, we start with the base NPV. It's negative. Negative, so let's have it in brackets. 0.49. 0.49. Add present value of interest tax shield. Present value of interest tax shield. So 9.7006. You less present value of the issuing costs, of equity, What do we call them? Present value of issue cost on equity. Present value of issue costs on equity. This figure here, 14.21. We say this one is in present value terms. This one is in present value terms, so we do not need to make adjustments. So you just say 14.21. You are lessing. Then you less present value of issue costs on debt, which is what? 3.6734. Then you get the adjusted NPV. You get the adjusted NPV. So we have 0.49 plus 9.7006. This one is negative. Minus 14.21 minus 3.6734. So I'm getting negative 8.6728. 8.6728. Yeah. So this is what we call what now? Kusumbua watu. Because these are a lot of work. These are a lot of work. However, this part here, this was the challenging part. This one. This was the only challenging part, and I would not wish it's that question must have been 20 marks. That question must have been 20 marks if these guys were fair. But from where I have, there are no marks. Not less than 10. It cannot be less than 10. So this part, I would not wish the same to be repeated. They should just be straightforward. They say 40% is debt, equity 60%. The issuing costs are maybe 2% of this 180 and 5% of this 270. Just a straightforward thing. Then you continue. I just hope you followed. Or Mulinga is 10%. It's 10 marks. Are you sure? So I just wish you followed. You're followed. So we started by getting the cost of equity. And again, let me tell you, never leave these questions unattempted. You must attempt. You must attempt. Even if you're not going to complete the question, but attempt. Just write what you can remember. Just write what you can get that particular time. For example, we said the cost of equity. That cost of equity you can calculate quickly because it's not complicated. You get the cost of equity. You can also make sure you also get the net cash flows. The net cash flows were straight. It is just the normal thing. You get the net cash flows. Just do what you can be able to do. What does not depend on something else. For example, the cost of equity does not depend on any other thing. It was independent. Getting the net cash flows was independent. You should get the net cash flows. After the net cash flows, we computed the base NPV. Maybe the base NPV, you may get it wrong because maybe your cost of equity or maybe the cash flows one, but still calculate that. Then if you feel you're going to waste a lot of time getting the present value of interest tax shield, just come here. You skip, just come here. Just come here. You write adjusted without calculating the present value of the interest tax shield, because that will take a lot of your time. Just come here, say adjusted NPV. You say base NPV, this figure that you got, then you less add present value of interest tax shield. You just say add present value of interest tax shield. You have no figure, so it will be blank. Less present value of issue cost. These issue costs, these are direct. You'll compute them. They do not need any discounting or what we said. They are in present value terms. So you write them here and you leave it at that point. So in that case, you will have eliminated this bit that is likely to take a lot of your time. Are we together? However, if you are in a position to do all this, you can do. But that is how you gather marks in an exam, doing what you are able to do. So let's proceed. Any question? Any question before we proceed? Any question before we proceed? There is a question in the past paper on adjusted present value. If I get the year, if I recall the year, I will share with you to go and attempt. I'll share with you to go and attempt. Let's go back to the WhatsApp group. Let's go back to the WhatsApp group. Let's go back to the WhatsApp group. There is a handout I shared on the WhatsApp group sometimes back. Let me get that handout. Yeah. Advanced financing decisions part 2. Let me reshare. Let me reshare this. Let me reshare. I've reshared. Yeah, definitely. What we'll be doing during the revision time is how to survive. How to survive. Because sometimes people do not fail because they don't know. People fail because they do not get, or rather, they do not have the best approach to the exam questions. Yeah, so we will go through that. So I've reshared the handout that I want us to look at in the WhatsApp group. Kindly check, kindly check. We must finish this today. Okay, we can have a 5 minutes break. Let's have a 5 minutes break. 5 minutes break. Let's proceed. Now, are you back? Are you back? I want us to proceed. Diana, are you back? Okay, fine. Now, we have what we call that handout there. That name is a bit difficult. We have what? Macaulay duration and modified duration. I wish you guys could assist me to read that name. So that is what I want us to look at. We're saying Macaulay duration and modified duration. Modified duration. And then we are saying Macaulay duration. Macaulay duration and modified duration are both measures of a bond's interest rate sensitivity. We're talking about interest rate sensitivity, but they serve different purposes. Macaulay duration, this one, Macaulay duration represents the weighted average time until a bond's cash flows are received. Weighted average time until a bond's cash flows are received. And remember, cash flows in this case are what? Interest. Weighted average time until a bond's cash flows are received. That is what we mean by Macaulay duration. The weighted average time until a bond's cash flows are received. Then the other one, while modified duration estimates the percentage change in a bond's price for 1% change in interest. So the modified duration estimates the percentage change in bonds what? Percentage change in a bond's price, for 1% change in interest, for a 1% change in interest. So remember, from financial management, you said that the price of a bond is equal to present value of interest. That means if there is a 1% change in interest rate, the value of a bond is expected to change. Because if we are saying the value of a bond, for instance, the value of a bond is equal to interest over a cost of debt, this cost of debt here, it is like the interest rate. Or here, for us to get the interest rate, there is a certain percentage that we multiply with a figure here, for example, like. So when this changes by 1%, how is the market price of the bond affected? So let's okay, you will go and read the rest of that. Go and read those other notes there. Just wanted to mention something, then we do an illustration. Let's go to December 2023, question 3C. December 2023, question 3C. December 2023, question 3C. Once you're there, kindly let me know. And you need to be there because you have very few minutes. Let's have an illustration further. I will clarify from the illustration. And I will clarify from the illustration. Let's go to December 2023, question 3C. Remember, for the Macaulay duration, we have said it's the weighted average time before a bond's cash flows are received. So I will show the weighted average time. So if you're there, December 2023, question 3C, the question says, a bond with a 5-year to maturity has a current value of 92.41, a coupon rate of 8% per annum, and a current market yield of 10% per annum. The bond will be redeemed at par value of shillings 100. Required, using the Macaulay duration method, compute the bond's duration. So from that handout that I've shared, there is a formula there, but we will still demonstrate here. So let's have some data here. We're saying a bond has with a 5-year. So the period is 5 years. The period is 5 years. As a current value is what we call B naught. So 92.41. Let's have shillings. 92.41. A coupon rate of 8%. So the coupon rate, remember, is the interest rate. And current market yield. Market yield is like the cost of debt. Current market yield of 10%. Cost of debt, 10%. Then we are told, using the Macaulay duration method, compute the bond's duration. So here we will have 1, 2, 3, 4, 5. That one is based on what? That is based on the bond's duration, 5 years. Then we have cash flows. Let's compute the cash flows here. Cash flows, this is just interest. This is interest. The bond's interest is 8% times 100. 8% times 100 is 8. Each year, the interest rate is, okay, we should have written par value somewhere. We should have written par value. Let's have the par value. Par value is equals to 100. So interest. And this interest is what we are calling cash flows. Cash flows. Because this is what the investor will receive from the bond. 8% times 100. We get 8. So here, you'll say cash flows 8, 8, 8, 8, 8, and we will have another year 5. Another year 5 here, we will have 100. What is this 100? What is this 100? This 100 is the redemption value. It's the redemption value. Remember, we are being told that the bond will be redeemed. The bond will be redeemed at par value of shillings 100. Now, I want us to go back to the handout. I want to clarify something. What is the definition that you said Macaulay duration is? Macaulay duration, we have said, represents the weighted average time. Weighted average time until a bond's cash flows are received. Weighted average time until a bond's cash flows are received. That's why you can see we are getting the bonds cash flows. We want to get the present value of this. Let us get the present value of this. So we are discounting at cost of debt. This is our discount rate. This is our discount rate, cost of debt. So we are discounting at 10%. So present value interest factor, 10%, which I'm saying is the cost of debt, which is the cost of debt. Let me write properly. This is cost of debt. Then here we will get the present value of the cash flows. So this one we have said is 1991. This one we have said is 8264. This one we said is 7513. This one is 0.6830, which I'm not sure. So let's confirm. 10%, 6830 is correct. And 6209. 6209. Here we are using the same. For year 5, remember this is year 5, year 5. Year 5, year 5. That's why we are using the same factor. Alternatively, you can add these two. You say in year 5, this person will receive an interest of 8 plus the redemption amount of 100. So let's multiply, and here we are getting present value of cash flows. So this is present value of cash flows. Present value of cash flows. So from calculators, 8 times 1991, it's 7.2728, then 8264, 6.6112, then 8 times 7513, 0.0104, then times 6830, it's 5.464464, then times 6209, 4.9672, then 100 times 6209, it's 62.09. Let's get the totals. Get the totals. 2728 plus 6.6, 112 plus 6.10, 0104 plus 5.464 plus 4.9672 plus 62.09. So this is 92. 0.4156. Then here write time weighted present value of cash flows. Time weighted present value of cash flows. Time weighted present value of cash flows. So the time weighted present value of cash flows, we are getting the cumulative. We are accumulating this. So for example, the first one is 7.2728. So this plus this, two seven two eight plus 6.6112, 13.884, 13.884. Another thing that you should be observing in an exam, it's about these decimal places. Always work with 2 decimal places, because they will reduce the time you're wasting on computations. Like in this case, we should have worked with 2 decimal places because these are not millions. 2 decimal places would have worked. But now that we've already started, 464, we get 25.3584. Are we on the same page? 4.9672. 30.3256. And the last one, 62.09. We get 92.4156. Then you get the summation. You're getting 189? 189.1508. So just a minute, I confirm something. Probably we're getting something wrong. We're getting something wrong. So time weighted is saying so we've gotten something wrong somewhere. The weighted 2. Sorry, we are not accumulating, sorry, we are multiplying. Get this, call this A. No, not A, sorry. Here, we should be saying this present value of cash flows, 7.2728 times 1. You get 7.2728. Then the second one, you get this present value, 6.6112 times 2. Then this one, you get 0.6104 times 3. Which 3? This is the period here. This is 1, this. So here you can say, this one we can say what? Call this A. Call this A. Call this B. So this is A times B. Make that correction. Make that correction kindly. 6.6112 times 2. So this will be 13.22. Let's have them in 2 decimal places. Let's have them in 2 decimal places. Then 6.0104 times 3. It's 18.03. It's 18.03. Then 5.464 times 4. It's 21.856. 21.586. Then 5 times 4.9672. It's 24.74. And then 5. Is that okay? 4.9672 times 5. Yeah, 24. Then the other one is 5 times 62.09. We get 310. 310.45. So then we add now, we get a summation 24.74 plus 21.856 plus 18.03 plus 13.22 plus 7.27. We get 395.566. 395.566. Then now, Macaulay duration is equals to the 395.566 you divide by 92.4156. The weighted average time before the cash flows of a project are received. So 395.566 divided by 92.4156. So here you'll get 4.28 years. 4.28 years. 4.28 years. That is how the Macaulay duration is computed. So the first thing we did was to get the cash flows. And I've said for the last year, you should be very keen because it's the interest amount plus the redemption amount. Then you get the present value of the cash flows using the cost of debt, using the yield to maturity, using the yield to maturity. After getting the present value of cash flows, you get the summation. You get the summation here. Then now you compute time-weighted present value of cash flows. Time-weighted present value of cash flows, we have said, you multiply the year times the present value of the cash flows. The period times present value of cash flows, you get this figure. Then you get the summation. Once you get the summation, you get the summation of time-weighted present value of cash flows. You divide by the summation of present value of cash flows like this. You get the Macaulay duration. So that is what we do. Now, go and attempt April 2023. April 2023, question 4B. Question 4B. And this will bring us to the end of that topic, which has been a long one. That is the advanced financing decisions. That will bring us to the end of the topic, advanced financing decisions. You can see how wide the topic is. This is a topic where you can get like 3 questions from this topic, broken down into sections. Yeah. So, and that is why I did not want to rush, because it's a major topic in advanced financial management. So one thing that we have not covered in this topic, the only thing that we've not covered in this topic is a rights issue. Rights issue. Rights issue. You remember rights issue? You did in FM. You did in FM rights issue. We will do a question on this during our revision. I will make sure I do one question on rights issue, but this is majorly what you did in FM, but we will have a question on rights issue. We don't need to waste a lot of time here, and this is something that we've already covered. So we'll just have a question on rights issue. Yeah. Yeah, you can have my number, Remoilinga. My number is, oh, okay.
So we see that conflict resolution refers to the process of resolving a dispute or conflict. So the process of resolving a dispute or a conflict by addressing needs and interests of all parties involved. So that's basically what's called. You look at, for you to resolve a conflict, you need to what? Address the needs and interests of all parties, because the conflict could be in terms of interest. So ensure that what? Each of those interests are taken care of. Involves communication, negotiation, and problem solving to reach a peaceful and acceptable agreement. So for conflict to be able to move on or to be resolved well, there must be a communication. When you're negotiating, for you to negotiate, for you to arbitrate, basically you have to communicate. Then negotiation, give what's called what? A give and take. So somebody gives a proposal, another gives an offer, somebody gives a counter offer until you agree, then problem solving. So that's basically what's called what? Conflict resolution. Means what? Dealing with the conflict or trying to what? Resolve the conflict, or to basically resolving the conflict or address the conflict. That's called conflict resolution. Now let's look at some of the mechanisms. We call them conflict resolution mechanism. There are so many ways in which, or so many methods of resolving conflict. So let's look at some of the major conflict resolution mechanisms. Now the first one is called negotiation. So you can decide to resolve a conflict by negotiation. Now, say that a direct discussion between the two conflicting parties to reach a mutually acceptable solution without involving a third party. So a negotiation is basically a discussion between the two parties, two conflicting parties. If we disagree, if you're in a disagreement, then we can say that, okay, let's say, for example, me and let's say me and Joseph would be having a contractual conflict. We have an issue due to the business we've done. So we can say that, okay, we are friends, we've been doing business and we hope to do business in the future. Why don't we sit down, discuss this issue, and then what? Come up with what? Amicable solution. So in this case, you don't involve third party. Just sit down as the conflicting parties and then discuss and find amicable solution, which each and every one of you will feel like what is the best decision for the two parties. So that's called negotiation. It's a discussion between the conflicting parties without involving any third party. You don't bring somebody else to help you. You just discuss between or among yourselves. Now, what are the advantages of negotiation? Why do some people say that what? In case of a conflict, let's go for negotiation. Let's look at what advantages of negotiation. Number one is cost effective. It's cheaper. No third party cost. So basically, the cost of hiring arbitrator or negotiator is not there. In this case, it is what? It is very, very cheap, cost effective. Number two is quick resolution compared to legal process. So if you compare negotiation with like litigation is the court process. You find that negotiation basically is quick. A court process basically it depends on the schedule. You'll be given the schedule depending on the workload the court has. So the court process may take long, but now with the negotiation, you can find a quicker way of resolving. Number three is what? Maintains privacy and confidentiality. Basically, in this method of conflict resolution, only conflicting parties or only parties to the conflict are aware of the conflict and resolve it. But if you go, for example, the court is a public institution. So basically, anytime you take a case to court, everybody will vote. Everybody will basically, everybody will know about it. So if you want to maintain confidentiality, then go for what? Go for negotiation. Then number four is what? Promote better understanding and cooperation. Anytime you discuss an issue until you resolve, then you must what? You must have better understanding between or amongst yourselves. And five, parties retain control over the outcome. So when you're negotiating means what? The outcome depends on you. So the two of you are the ones that are supposed to maintain control to ensure that you're able to get an amicable solution. Then you go to disadvantages of what? Of negotiation. Why is negotiation some people don't like? Why are some people against negotiation? One look at what some of the disadvantages of negotiation. Number one is what? Power imbalance may affect fairness. That's very true. Sometimes if you're negotiating with a very power or very senior person, then basically because of their power, position and their power, they may what? They may twist you to agree on what they think. Then number two, may not be resolved deep-rooted issues. So there are some issues that are deep-rooted that negotiation will just what? Will just cover them up, but the real problems will not be resolved. Then number three is what? Risk of manipulation or coercion. So in a negotiation, one party may be coerced or may be manipulated. So if I can find what? Somebody can be manipulated or coerced. Coerced means what? They may be forced to agree on the decision. So in a negotiation also, you may think it's a free, but now sometimes there is what? A little bit of what? Manipulation and coercion. Number four is informal. Agreement may lack enforcement power. So if you resolve a conflict by negotiation and then one of the parties goes to court again, basically, or one of the parties said that what? The issue was not resolved well, then basically cannot go to court again because that what? Resolved by negotiation. Negotiation is not in law. It's allowed, but basically, if somebody goes to law, the court will still hear the case, even after resolving it through negotiation. And then number five, can break down if parties are unwilling to compromise. So sometimes in negotiation, there's an issue of compromise. If every party becomes a hardliner, then basically the result of negotiation may not be good. So we need to show that what? When you go to negotiate, go with an open mind. That what? There are things you are supposed to what? You're supposed to compromise in the negotiation. So that is what can break down if parties are unwilling to what? Compromise. So that is negotiation. On the negotiation, are we good? Are those points clear on negotiation? Both definition, advantages, and disadvantages. Are they good? Negotiation, is it good? Thank you, JK. JK is saying good. Monica? Joseph? Okay, thank you very much. So I think we are good. That's, I think, the only people that there. Thank you very much for the response. Joseph. Now let's go to mediation. Another one is called the mediation. After negotiation, there's this one called mediation. What is mediation and how is it a conflict resolution mechanism, or how is it applied? So let's look at mediations. That this is a neutral third party mediator, facilitate communication and help the parties to reach a voluntary agreement. So in this case, you bring somebody else, a third party called what? A mediator. Now, a mediator is just supposed to come and help you discuss. Sometimes there could be a conflict whereby you don't see eye to eye. So you bring a mediator to help in bringing you together and also help you in discussing the issue. But now, the only difference between mediation and negotiation is what? Is that now we have a third party in between. But Basically, the outcome of the resolution of conflict is still in your hands. This guy is just there to control how you discuss your issue, but whether you agree on the conflict or whether you agree to resolve the conflict or not depends on the two of you. A mediator will not decide for you. It's upon you to discuss and then what? End up now making what? Or getting the right decision. Now let's look at advantages of mediation. Number one is neutral mediator fosters fairness. So because the mediator is neutral, it does not support any party in the conflict, then you're able to watch. There's going to be fairness in the results. Then less adversarial than court process means it is with mediation. Basically, there's some aspect of what maintaining good rapport or relationship among ourselves. Then maintain relationship between parties. Then also maintain relationship means what? If we are able to discuss a conflict through mediation and agree, then we're still becoming friends. We can still do business in the future. Number 4 is what? Confidential and private. Basically, the only third party here is the mediator, but the discussion, everything is what? Is confidential and private. Now 5 is what? Parties have control over the outcome. So in this case, the parties have control. It's upon you to decide. The mediator does not have a control. The people that are controlled to decide or make a decision now are the mediator. So basically, are the parties. So the mediator will just be there. If you don't agree, the mediator will just go his way. He will not force you to do anything. Now, let's look at disadvantages of mediation. Why some people are against mediation as a method of resolving conflict. Number 1 is outcome may not be legally binding. That's very true. Even mediation, the outcome of mediation, if somebody decides that after mediation they still go to court, the court will still listen to the matter. The court will not say that now because you mediated, we are going to stop. No, the court will still listen to the matter. So basically, it is not legally binding. Number 2 is no guarantee of resolution. Even by bringing a mediator, sometimes the parties may not still agree. And then number 3, cost may arise for mediator services. So some of these mediators, we call them, they are qualified mediators. Basically, you're supposed to go to school to do mediation and even what? Arbitration. These are not things that you just wake up and, although traditionally in the African setup, we had them who are people who are just traditionally brought up to be or trained to be mediator. But basically right now, for you to be a qualified mediator, there are some exams you have to do, basically. Then talk of number 4, less effective if parties are willing to cooperate. You can only mediate when the parties are willing to discuss the matter of conflict. If they are unwilling, if they're not willing, even as a mediator, you just go home. Last one, may delay resolution if prolonged. Sometimes mediation can take time, so it may end up what? It may end up basically delaying the decision making. We go to the third dispute resolution mechanism called arbitration. Now, here we also have a neutral party called the arbitrator. An arbitrator is like a judge. Now, arbitration has got some legal backing. Arbitration, negotiation, mediation, those ones don't have any legal backing. But now, arbitrator is like what? It's like a judge. Arbitrator will decide on what he thinks is best for you. Now, so that a third party arbitrator hears both sides and makes a binding or non-binding decision. Advantages is faster than court litigation. So basically, arbitrator is like a judge. He listens to both parties and then tell them, from my evaluation of the conflict, this is the best solution. He decides for you and say that what? Now all of you must abide by what the arbitrator says. That's why an arbitrator must be neutral. When you feel like, when you believe that the arbitrator is not going to be neutral, you don't allow it. So an arbitrator must be accepted by both parties. So that what? When he makes a decision, everyone will believe that what? That's the best decision for the party. Number 2, so that's faster than court process. That's advantage. Number 2 is what? Arbitrator decision is typically final. It's like a judge. An arbitrator is like a judge, but you can appeal. So that's why this very that one. More formal and structured than the mediation. So basically, because that's why it has got a legal backing, it's more formal than mediation. Then number 4, confidential process means what? The issue is just discussed between the conflicting parties and the arbitrator. Then number 5 is what? Can be tailored to specific industry knowledge. So depending on what you are arbitrating on, you can tailor it to the knowledge you have. Then we have disadvantages, problems. Some people are against arbitration, and their reasons is number 1, can be expensive. That's very true. Getting an arbitrator fee is normally can be high, so can be expensive process. Then limited opportunity for appeal. You cannot appeal, but if you go to higher courts, you can also appeal. then may favor more powerful parties. Sometimes even the arbitrators can what? Can make decision to what? Favor the powerful parties. Then number 4, less transparent than courts. Because in arbitration, they are not people who look at the law so much, so they may not be transparent. And then parties have less control over the outcome. In this case, what you do is what? You do your submission to the arbitrator, the parties. Then outcome you don't have control over. So the arbitrator will look at your submission and say that what? This is the best decision for the two of you, and then you go ahead. That's called arbitration. Now, on the arbitration and mediation, are we good? On arbitration and mediation, are we good? There's a question here. That's a very good question. Somebody is asking me a question here. Who is this? Very good question. A question by Maina. Maina is asking, what is the main difference between mediation and arbitration? Now, mediation, a mediator or mediation is whereby you bring a third party, and that party's work is to ensure that you discuss your issues and then you resolve it yourself. Sometimes you find that you feel like meeting somebody, if you have a conflict with somebody, meeting and discussing that issue is difficult. So you bring somebody, a neutral third party, who just sits there and help you discuss the matter. Nakwambia, wewe umeongea sana, wewe pia ongea, what do you say about that? So basically, he just helps you to discuss. But now, it is you to decide on the solution of that problem. It's you to decide the solution of what? Of the conflict. It is just there to help you discuss, but then later, it is you conflicting by what? That to look at for solution for your problem. But now, an arbitrator is like a judge. Arbitrator basically will listen to both of you. You say, now, party A, give us your submission. Party B, they say that what? Having looked at all the submission of the two of you, I think the best solution for you is to do A, B, C, and D. He decides for you. He's like a judge. And whatever he says stands. But for the mediator, he doesn't make any decision. He just helps you to discuss your issue and then you resolve by yourself. But for arbitrator, he decides on what is the best solution for the two of you, and you have to sign that you agree with that. Patanisho. Somebody has a case doing patanisho. Patanisho is just basically a mediator. Patanisho. Arbitrator is now like a judge, although not a court process, but basically as a judge. I don't know if you answered, Maina. Is it? Okay, Maina is well understood. So we have talked about those three. Then we also have another one here called litigation. Litigation is basically the court process. Those who go to court now, that's called litigation. Let's look at litigation. So conflict is taken to court where judge and possibly jury makes a legally binding decision. So a judge, when it's one, when there are many judges listening to your case, is called a jury. Many judges are called jury. So if you take a case to court on a conflict, they look at your submission, everyone will submit, they look at the law, and then what? They decide on the way forward. Now, what are the advantages of this court process or litigation? Why do some people believe that what? Going to court is the best option? And what is what? Legally binding and enforceable outcome. So when the court makes a decision, is legally binding unless you go and appeal. Number 2 is what? Public record can act as precedent. So basically, they look at the public record. Which judgments were made on similar cases? Then they decide. Then structured and well-defined process. So a court process is basically very structured. There's a mention, there's submission, there's what. So basically, it's well structured. Then parties have a legal position. Means what? If you are a part of the conflict, you can get a lawyer to help you represent you in court. So basically, you're allowed to get a legal representative in court. Then ensure legal rights are preserved, protected. So basically, the court will always look at the rights to ensure that what? The best decision prevails. Then you also have disadvantages. There are people that are against going to court. And number 1 is what? Expensive due to what? Legal fees. Expensive if now go and also hire a lawyer. It can be expensive. Number 2, time consuming and stressful. A court process can take 10 years. So basically, very time consuming. Then public lack confidentiality. This is what? Anything that has be taken to court is not a private matter anymore. It's a public matter because the court is an open place. People will come and hear you. Nobody will lock the door. Hakuna mwenye atafunga mlango ati mna discuss issue hapo. No. The court is a public process. When something goes to court, we have a right to come and listen and even what? Inform the public. So then damages relationship between parties. Anytime you go to court, anytime a commercial dispute is taken to court, and then the court decides, sometimes you may never do business again, because some people believe that what? Once you take them to court, they cannot trust you anymore. So basically, it can destroy what? Relationship between and among companies. And then limited control over outcome by the parties. At the parties, the best you can do is what? To submit your case or do your submission, but the outcome of the case depends on the presidents and also on the judges. Look at the substance matter of the matter and the legal aspect. Then we have this one also called conciliation. Another one called conciliation. Another dispute is called conciliation. So a third party conciliator actively participate in the resolution process, often suggesting solutions. So basically, in conciliation, the conciliator suggests solution. Anakwambia, with your submissions, I believe that solutions are either A, B, C, and D. Then upon you to choose the one. So he is able to suggest for you solution. Then what you choose one that's good for you. What are the advantages of conciliation? And one is what? Encourage a settlement through compromise. You compromise. Same as negotiation. Then what? Maintain relationship. That's true. Cheaper than arbitration or litigation. Conciliation is normally very cheap. And then conciliation process. We talked about that. And then informal and less intimidating. Basically, this one is you sit down as a. It's not so much formal. So basically, informal. And that's what? Less intimidating. Like a court process is intimidating. People just say that, okay, I'll go to court. Once you go to court and the court case is now ongoing, you find it very intimidating, basically. Then disadvantages, number one is what? Not binding. Parties may not honor agreement. So with conciliation, the parties may leave the table there saying that we are good. When they go outside, everyone will start doing their thing. So basically, they may not respect. Number two is what? Conciliator may lack authority because he's only going to suggest. So basically, he cannot enforce anything. The risk of perceived bias. So the conciliator must also be biased. The conciliator may also become a little bit biased. And then less effective in high conflict situations. So this one's normally what? If the conflict is a high level of conflict, then basically this cannot be what? A good one. Then another is what? May not address power imbalance as well. Means that sometimes when what? The conflicting parties have got different powers. Others have more power than the rest. So basically, can be a problem. So on conciliation, are we good? On conciliation, are we good? Hello? Yes, now, as we conclude, I want to explain to you something that when we talk about negotiation, mediation, arbitration, and conciliation, we call them what? Alternative dispute resolution mechanism. We call them ADR. They are called alternative. Means what? Instead of going to court, you can use those ADR. And sometimes even the court will tell you that, okay, you've come to court here, but we are giving you 1 week. Go and try to resolve this issue outside. Go and try to resolve this issue among yourself. If you bring it back here, we'll decide as a court. Even in family matters, I've seen when people are fighting for properties or when there's an issue of child and those issues of custody, sometimes the judge will give you a leeway. Like, go and think about this thing, go and take 1-2 weeks, discuss the issue, and then come back. If you don't agree, then basically I'll make a decision as judge. And sometimes some decisions are very painful. Sometimes the judge will make what? Illegal but very painful. Emotionally, it will be very too much. But basically, it's the right decision. However, painful it looks like. I don't know if you have seen some cases. There's a case that was very famous whereby the woman took the husband for child custody to the court. And now, the court decided that the children or the child should go with the father, not with the mother. But now, the children don't want to go with the mother. And then chaos erupt in court. Then there's chaos, the children are running up and down. So those aspects, you see, the judge might have made the right decision. But now look at the impact in terms of what? Look at the emotional turmoil that now it comes with. So that's why sometimes you're told, you want you to discuss about custody of the children. Can you just go and agree as people, and then you find an amicable solution so that you say that this is what you want to do? It's better. But other than, because once the court decides, the court order has to be implemented. Hata kama mtoto atabebwa mpaka hapo kwa mama yake akae huko for some time. Because what? Unless you come back to court and then what? And then appeal. That's what can happen. So such kind of things happen. That's why what? They normally give people what? A chance to discuss outside before. So now let's go to another subtopic here. Talk about ethics in leadership. So basically, ethics is about morals. So ethics are basically moral principles which guide behavior of individuals. Ethics means oral principle which what? Guide behavior of individuals. Now, professional ethics means moral behaviors which guide behavior of people in various professions. When we talk about leadership, ethical leadership means what? Applying moral principles in carrying out what? The leadership position or activity. So ethics leadership refers to principles and standards that guide the behavior of leaders in making decisions, influencing followers, and managing resources. Ethical leadership is crucial for building trust, promoting transparency, and ensuring sustainable success in one nation. So basically, you must what? Manage the company ethically. Now, let's look at ethical concepts. You can call them ethical concepts or ethical aspects. As a leader, what are these ethical aspects that you must have to ensure that what? You manage the company. Number one is what? Integrity. As a leader, you must be a person of integrity. So ethical leaders demonstrate honesty and consistency in their values, actions, and decisions. They do what is right even when it's difficult. So integrity means what? Doing what's right even in when it is difficult. At the same time, doing what is right even if nobody is looking at you. Now, the next one was what? Accountability. As a leader, you must be accountable. So leaders take responsibility for their actions and outcomes of their action. They hold themselves and others answerable to ethical standards. So basically, as a leader, you must be what? Accountable for resources you're given and also for your actions. Number three is fairness. Ethical leaders treat all individuals equitably, avoid favoritism, and make impartial decisions based on merit. So as a formal leader, you must be fair in terms of what? Avoid favoritism, avoid impartial decision making. So ensure that what? You are very awake when you're making decisions. Then number three is fairness. As a leader, you must be fair. So ethical leaders treat all individuals equitably, avoid and make an impartial decision. Basically, as a leader, don't favor anybody. Ensure that you manage objectively. Don't be subjective. Don't there are people that you talk bad to. There are people that you demand action to, but the others that you babysit. So as a leader, try to be fair. Then transparency. Open and honest communication help build trust. Ethical leaders share relevant information with stakeholders and avoid. So basically, ensure that what you're transparent in what you do, so that what the employer know. Then respect for others. As a leader, you must respect others, whether your peers, your seniors, or your juniors, or subordinates. Ensure that what you respect. So ethical leaders with ethics show consideration for others' rights, opinions, and dignity. They foster inclusive and respectful workplaces. Very true. Then social responsibility. Ethical leaders extend beyond the organization, considering the impact of the decision on society and the environment. So in this case, as you carry your leadership activity, ensure that you also achieve what? Environmental sustainability. You look at ECG, call them environment, you look at the social and also governance. So as you manage the company well, which is governance, ensure that what your company to achieve their social economic objectives. Then last one is role modeling. As a leader, you must be a role model. You must be a role model to the people you are leading. Very important. So say that leaders serve as ethical role models. Their behavior sets the tone for organizations, what culture, and influence others to act. So as a leader, act as a role model. When you're picking bribes and the juniors are seeing you, basically you tell them that what is okay to take bribes. So basically, try to be what? Try to be a role model by doing the right thing. Then you go to importance of ethics in leadership. How is ethics important in leadership? Let's look at importance of ethics in leadership. Number one, build trust and credibility. If you are ethical, people trust you and also people know your credibility. Then enhance employee morale and loyalty. So basically, with good ethics, we are able to ensure that what? It boosts employee morale, because you do everything you do to ensure that what? The employees' work environment is improved. Then minimize corruption and misconduct. Go talk about issue of integrity, ethics. You try to what? Eliminate any misconduct or any ethical issue. Then support long-term success and sustainability. Very true. With ethics, we will do what? Ensure that in the long term, we are able to access, you're able to what? You're able to succeed, long-term success, and what? Sustainability, you are able to sustain your production for a long time. And the last one is strengthen the organization to what? Regulation. So if as a company, if you have, if maybe, if as a company, when people know that you're fair, you're ethical, you're fair, you're transparent, you respect others, you carry out social responsibilities, and you also are role model, then people will what? Will always give you, respect you. So that is on what? That is on ethics and leadership, or ethics and management. Any question on ethics? Any question on ethics? Any question on ethics? Any question on ethics? Hello? Usinyamaze hivyo. Any question on ethics? Okay, so there's no question on ethics, so I think everybody is okay on ethics. So I think that ethics is important. Ethics is one of the most sensitive areas to discuss, because ethics is an area that needs a lot of attention. We need to be ethical in whatever we do, whether at workplace, at personal level. You need to be ethics. Ethics will save you a lot of things. Issues of corruption will not be there. If we were able to teach ethics in school, then issue of corruptions will not be there. Issues of lack of transparency will not be there. So ethics is very important. We need to ensure that we teach ethics from the onset. Even the young people should be taught about ethics in governance, so that they know that you don't become an MP to steal. You become an MP to what? To be able to solve people's problems. So ethics is very important that we understand. Now, I want us to go to the next topic. Give me 1 minute. I take a glass of water. Then we can go to just 1 minute. So I'm back. Let's look at decision making. This one is a very important aspect in management, and not only in management, even in life. Life is a series of choices. You make decisions on daily basis. So it is important that as a manager of a given company, or as a manager or a leader, you will be required to make decisions. And those decisions will shape the future of the company. If you make a good decision, the company will succeed more in future. If your decisions are not the right decisions, then you may end up what? You may end up what? Taking the company in the wrong direction. So decision making is a very important aspect that every leader must ensure that they embrace. Now let's look at decision making. So the first thing we need to start by defining decision making. So the definition is that decision making is the process of selecting the best course of action among several alternatives. to achieve a specific goal or resolve a problem. So basically, for us to make addition is a choice out of the several alternatives available. If there's no choice, then don't decide. We only make decision if there's choices. If there's only one decision to be made, then you don't make a choice. But there's a case whereby there are options, like 5 options that can be taken. Now, you look at which is the best options among them. That's now what's called what? Making a decision. You look at all the options and look at what is their merits and demerits. What are their financial obligations? So basically, you make a decision subject to what? Subject to availability of different alternatives, and after analyzing each of the available options to choose the best for the company or to resolve the conflict. Now, let's look at importance of decision making. Why do we make decisions on a day-to-day basis? Why is decision making important? Let's look at importance of deciding, even at individual level. Number one is what? Problem solving. A decision can solve a problem. You may have a problem in the company, but just one decision resolve that. For example, your employees may be having a go-slow. There's a go-slow in the company because they feel like the work environment is not conducive, or they feel like they're not being paid fairly. Then what do? You make a decision to ensure that what? You want to make their work environment very conducive. And with that one, you've been able to what? Solve problem. You tell them that, okay, we understand that you are complaining you're complaining about the, what do you call it? You're complaining about maybe something like the payment that is not adequate. From next month, we are looking at it to ensure that what? All of you are able to be given something small. By just doing that, you'll be able to what? You'll have solve a problem. So number 2, that enable identification and resolve problems effectively and efficiently. Number 2 is what? Goal achievement. So help individuals and organizations set and achieve objective by choosing appropriate action. So basically, decisions can also help you what? To achieve the goals of the company. If you make the decisions you make can either help you or foster or inhibit your ability to what? To achieve the objectives of the company. So goal achievement is based on what? The decisions. Like right now you're in class. There's something you want to achieve. Basically, if you get this CS or CPA or ATD certificate, you know that it cannot open some doors. So basically, you decided to come to class. When others when others in the evening are relaxing, you're in class. Or Saturday when others are relaxing, moving around, you're in class. Because you've decided that that's what you want to do, so that it helps you achieve some of the objective in future. Even management also. Then what? Number 3 is what? Resource allocation. Ensure optimal use of available resources in terms of time, money, materials, and manpower. So you need to know from the economics knowledge that resources are normally scarce. We talk about what? That resources are unlimited. But human needs are, resources are limited, means they are few, but human needs are unlimited. Means resources are few, but our needs are extremely many. And because of that, we need to choose. So talk about what? So even finances, you go to a company that talk about finance, they say that what? We don't have much money. So because we don't have much money, we have to choose which areas of the company to put more money on. Even at individual level, we may not have enough money to take care of all our needs. But now the little we have, we can decide, we can now make a decision to know where to allocate the resources. Some of you have taken a small bit of it or some portion to school fees. Another one to maybe other aspect projects. So basically, with decision making, you decide on this what I have. How can I break it? So you make a decision on how to break your resources in terms of time, in terms of money, and also material. So basically, resource. Then number 3 is what? Risk management. So allows anticipation and mitigation of potential risks by evaluating possible outcome. So basically, they should also help you to what? To manage risks, because risk management techniques are also many. You have to decide on which one you think is the best one. You can talk about risk avoidance. You can talk about risk transfer. You can talk about risk acceptance. You can talk about what? You have risk avoidance, risk acceptance, risk transfer, risk sharing. So you have to decide on the best way. You identify the risk, then decide on which is the best way to manage such kind of risk. So risk management. Then number 5 is improves efficiency. So for that, what? Timely decision that improve productivity and operational flow. So basically, if your decision on what to do, for example, you say that well, now people are registering online. Online makes what? Make registration process what? Efficient, because we could be having somebody in Mombasa. They may not come to Nairobi to register. So if you need to register, we just give them a system. They're able to ensure that they register from Mombasa very well. So basically, issue of what? Efficiency. Number 6 is adaptability to change. You all decide on how to adapt to change. This decision. So support flexible and informed response to dynamic environment and unexpected situation. So you can decide on how to be able to what? To change in the environment based on what? The prevailing factors around the business. But 7 is what? Enhances accountability. So make it easier to track outcomes and assign responsibility for what? Decision. So basically, decision helps what? Help in what? In enhancing accountability. If I am a CEO and then I decide to carry out a particular activity, I become accountable for it. I cannot run away. I just said, this is what I decided because of AB. So basically, they should also what? Help to enhance accountability between or among the people in leadership positions. Any question of that point on the importance of decision making? Any questions? Any questions on the importance of decision making? Any question? Ishmael, no question? Any other question? Monica is saying clear. JK, we are good. Thank you, Monica and JK. Mine, I say no question. Any other person? Joseph has no question. Who is remaining? Any question? So I believe everybody don't have a question. Zipora, thank you. No question. So I think it is clear. So we can proceed to the next subtopic where I want to look at something called decision-making models or approaches. So there's something called models or approach that are used to make decisions. There are people who did some research and found out that there are some models that we can apply to help us what? Make the right decision. So let's look at the models of decision-making, models or approaches. So that a systematic and logical approach, look at that statement, systematic and logical approach, where decisions are made by identifying the problem. The first one is called rational, sorry. The first model is called rational decision-making. A rational person is a person who thinks best. You look at various factors before deciding. That's called a rational person. So that a systematic and logical, this one, rational means what? You must be systematic and you must be logical approach where decisions are made by identifying the problems. First thing, identify the problem, generating alternatives, evaluating alternatives, and choosing the best alternatives, implementing it, and then monitoring the result. So that's called rational. You follow the procedure whereby for you to make a decision first, you must define the problem. What is the issue that you want to make decision on? Then number 2, alternatives. What are the possible solutions for this problem? Number 3, evaluate the alternatives, and then choose the best one, and then what? Implement and then evaluate. Now, the second is called bonded rationality. The first one is called rational decision making. Then you have what's called the bonded rationality. This one is also a model of decision making. Now, what is bonded rationality? So that recognize the limitation of human cognitive capacity and information availability. Decision makers opt for satisfying solution, one that is good enough rather than optimal. So in this case, we are looking at, say that, recognize that the limitation of human cognitive capacity. Say that word. Even a human being can make an error in deciding. Let's talk about what? Limitation means human cognitive capacity may not be sufficient. Provides the limitation on human cognitive capacity and information availability. Means what? Sometimes human being may not think right, they may make wrong decision. At the same time, issue of what? Information. For you to make a good decision, you must collect data. Sometimes you don't have that background information to what? Help us make a good decision. Decisions makers opt for satisfying solution. Means what? They look at what satisfies them the most. What satisfies you the most, or what satisfies the company the most? That's what they go for. So solution, one that is good enough rather than what? Optimal. Don't look at aspect of optimality. They look at what? What is really satisfying for the human, for the company, and not what is what? Optimal. Number 3 is called intuitive model. intuition. This is basically based on your experience and your inner feeling. Intuition is basically called inner feeling. It's called intuition, the intuitive model. Now see that decisions are based on experience. So basically those who are intuitive decision makers, they say that it will make decision based on experience, gut feeling, and instinct rather than what? Formal analysis. So just look at the experience you've had in management. These problems have come and you've already solved them. Then feeling, what's your feeling about decision? And then last one is on instinct rather than what? Formal analysis. Useful in situation with incomplete data or when quick decisions are needed. So if you're working in a place where you don't have historical data, there's no you have not made such a decision before. So in that case, you can go for what? You can go for intuition, your feeling, your experience. You can make decision based on your feelings and experience. Then number 4 is called recognition primed decision making model. Recognition primed decision model. So combines intuition analysis. So basically this one carries what? Your gut feeling and also analysis. They use data. Decision makers recognize patterns from past experience combined with intuition. They look at the history of the, or maybe sales for the last 5 years. They can check on that. And then they also bring what? They also bring the aspect of what? The aspect of their intuition, their feelings based on the data, they're able to make a decision. That's called intuition or recognitive prime. Then we have what's called incremental model. This is also another dispute resolution technique. It's called incremental model. So decisions are made through small sequential rather than large radical changes. So in this case, we decide slowly. For example, if I want to implement ICT in the company, I want to digitalize the all company activities. What do? I start with the marketing department, we are done, go to another department until you finish. So basically, you are supposed to follow a process before you are able to achieve the objective. Then number 6, follow what? Political model. So focus on decision making as a result of negotiation. So basically, this one, they said what? If you want to make a decision, negotiate, resolve conflict, and also power struggle. So ensure that what? For you to make a decision, you must what? You must define negotiation. You must find a way to resolve, negotiate on conflict and power struggles among different stakeholders. So that's called political, where you try to what? Do what's called, you try to mobilize so that people are able to what? Agree with you on the decision you're making. Now, on the rationale, on the decision-making models, are we good? On the models, are we good? Or the models, are we good? Hello? On the decision-making models, are we good? Yeah. I've seen a few people have said they're good, so we can proceed. So I want to look at a small subtopic here. Nani, where's the prayer time? Ishmael, when is the prayer time supposed to be? 1. 1 is just 2 minutes away. So we can have a small break and come here at exactly 1:10 to look at types of decision. So let's come here at 1:10 to look at the types as we give our friends just a few minutes for prayer. Let's come here at 1:10 to discuss these issues very fast. So you have a small break. mid-level management that are supposed to drive the company towards long-term objective or towards achieving this future mission. So you talk about the mission and goals basically are then we have what's called tactical decisions. These are basically middle level decisions. Strategic are top level, then tactical are basically middle level. So tactical are medium term, means what? They're not long term. Strategic are long term, this one's are medium term that focus on implementing strategies through efficient allocation of resources, both financial, capital, human. Look at them. They're usually made by middle management. Talk about what? So tactical decisions are normally middle level management decisions by middle management and involves planning and coordinating activities within departments. For example, planning a marketing campaign or adjusting production schedules are tactical because they are departmental decisions. For example, a marketing campaign will drop until what? We remain with the best one. So that's what. Number 5 is what? Choose the best alternative. After evaluating all of them, you drop until what? Remain with the best. So choose the best alternative. What has happened here is that what? This is a step where the decision maker select the option that offers the greatest benefit or best solution to the problem. The choice could be based on evaluation and decision maker's judgment. So you choose the best. And then number 6 is what? Implement. You don't just choose. Choosing without implementing is as good as not deciding. So once you make a decision, then implement. Put in action, basically. So involve putting the chosen decisions into action. This step requires planning and implementation, allocating resources, communicating the decision, and assigning responsibility to ensure effective execution. So here, for you to implement a decision, you must be able to what? Commit resources, both financial, human, to ensure that what? We are able to take care of all the aspects of the implementation. And the last one is what? Monitor and evaluate. Once you make a decision, don't just go and say that they have decided. Now look at, evaluate and find out, is the decision helping you become better or not? If with the decision you're still not making, you're not basically still making progress, then you start from number 1 again, a problem again. So until you get the best solution that is able to help you, but best solution that doesn't mean that what is able to cure the problem 100%, but at least it must help you do what? You must see some progress. That's the decision making process from number 1 to number 7. So at the evaluation is where we decide now to continue with the same decision or to choose a new one or to go to the process again. So those ones are, that's the process of decision making. Very, very important and very critical. Now, the next subtopic is what's called problem solving skills. As a manager or as a leader, you must have skills to solve prevailing problems within the organization. So that problem solving skills are essential for effective identifying and resolving issues. Let's look at some of the key skills that you can use in solving problems. Number 1 is called analytical skill. That is very true. For you to solve a problem, you must analyze the situation. Analyze first. Say that, okay, this is what happened. Can I analyze what could be the cause of this thing? So basically, the ability to break down complex problems into smaller, manageable parts to understand the cause and effects clearly. This involves examining information logically, and so basically, critical thinking involves several things. What is what? First thing is what? This problem looks very big. Can we break it down? If you break it down, can we find some of the causes and the effects so that we're able to make the best decision? So you must have analytical skill to be able to what? To solve a problem. You must have analytical thinking skill to be able to solve a problem. You don't just think superficially. You must think critically. Number 2 is creativity and innovation. Basically, for you to be able to solve a problem, you must be creative. Don't use the same problem-solving technique that's applied by others. You can be creative enough to be able to what? Come up with a better solution than any other person. So be creative. Ask yourself, can I find a better way to solve the problem? So this is a capacity to think outside the box and generate a novel and unconventional solution. Means what? We talk about novel and unconventional, means what? There are new decisions that are very good but have never implemented somewhere. That means what? You are innovative. You are thinking. You are creative. You go beyond the necessary. You go beyond the what? Beyond the ordinary to ensure that what? You come up with the best solution. So then the next one is critical thinking. We talked about analytical thinking. Now here is about what? Critical thinking. You look at things very deeply. A critical thinker looks at situations very deeply before they decide something. So you talk about critical thinking. Now, evaluating information objectively. You evaluate them professionally. You don't bring your personal biases, because your biases can make you what? Make wrong decisions. In this case, you look at a decision information objectively. Avoid your personal bias. You can what? Information, and then what? And make reasoned judgment. It involves questioning assumptions, the so-called assumptions in decision making. You question assumptions, identifying biases, and assessing evidence before deciding on solution. In decision making, you have something called biases in decision making. There's something called biases. One of them is what? We have what's called conditioned biases, whereby we are biased because of the previous. We can be biased. For example, if I made a decision today and then it works, next time when I face the same problem, because the decision worked for me last time, that's a bias. Can make what? Make the same decision this time, but it may backfire. So you must be a critical thinker. Then the next one is decision making. For you to resolve a problem, another skill to solve a problem, you must what? You must be able to choose. Sometimes it's difficult because all choices look the same, but at the end of the day, you must decide on the best way forward. So you have to decide. You may analyze situation and find that what? I have 3 very good options, but at the same time, you have to decide whether you're going to use what? Your inner feeling. What's called what? You are whether you're going to use your gut feeling to decide. But basically, you have to decide. Then communication. It's very important. So effective sharing of information, ideas, and solutions with others involved in problem. Good communication ensures everyone understands the problem and the proposed solution. So basically, sometimes you need to explain to people why you chose A and not B, or where you are able to solve this problem. So basically, sometimes you have to explain to people that we are making this choice because of A, B, and C. So you must have what? You must have very good command of both communication, or both written and spoken language to be able to what? Gather information at the same time, convince others that what this was the best. Then last one is what? Collaboration. You must know that sometimes decision is not made individually. Sometimes you need to what? Engage with others or work with others to make the right decision. So collaboration becomes a very important aspect or another important skill. Then we go to another subtopic here, a very small subtopic here, which talks about decision making under different conditions. So sometimes as a manager of a company, we make decisions in different situations or scenarios. Some make decisions when employees are on strike. Others make decisions when they're just in the boardroom. So those are 2 different situations. Some are very tense, some are very okay. Now, let's look so that decision making varies depending on the amount of information available and the certainty about the outcome. Below are some more details, explanations of decision making under different. So the first one, the first condition is what? Decision making under certainty means you know what you want. You are certain, basically. So that decision maker knows with certainty what the outcome of each alternative will be. So I know that if I do A, this is what is going to happen. If I do B, if I choose A, this is going to happen. If I choose B, so in this case, I know the outcome of the possible solution. So I choose the one that I believe is going to be what? The most optimum outcome. Now, what are the features of this one? Number one is what? Outcome are predictable and known. So in this case, when I choose make a decision, I know that what? This is going to be the outcome. Number 2, risk is minimal or absent. So with this calculation, basically, the risk is minimal or absent because you already know the consequence of the decision you're going to make. Example, choosing a product from a supplier who guarantee delivery on a specific date. So basically, that's called what? That's called decision. You are certain that you're going to supply this item because you've already evaluated them and know their approach. Now, the The second one is called decision making under risk. When you're facing a risk and you want to make a decision, called decision making under risk. What is this type of decision making, which is called decision making under risk? How does it operate? So we said that definition: decision maker knows the possible outcomes of each alternative, but does not know which outcome will occur. In this case, I know that these decisions, the possible outcome of this decision is A, B, C, and D. But in those A, B, C, and D, those possible outcomes, I don't know with certainty which one is going to come. I know that what this decision can give me 4 possible outcomes. But now I don't know exactly among the 4 outcomes which one is going to come. Basically. So decision maker knows the possible outcome of each alternatives, but does not know which outcome will occur. The probabilities of each outcome can be estimated. Means what? In this case, you just what? Use your analysis to be able to look at the probability. Some of them could be have high probability, others less. Now let's look at statistics. Number one is what? Probability is knowledge of the outcome. There's something called probabilistic knowledge. A probability is basically the mathematics of chance. Probability basically what? Is a statistical aspect of chances. What's the chance of happening? So you make a decision based on what? And knowing that this one has got 9 over 10 chance of happening. This one has got what? 2 over 2. So basically on those, based on the chances, you can choose the one that you think is best for you. Then require risk assessment and management. For this one, you need to what? Because you're making decision under risk. You're making decision under risk. So basically you must what? Assess the risk better. Example, investing in stock where historical data can estimate chances of profit or loss. So you know that investing in shares, there are times when those shares gave profit, there are times when also people got losses. So when you decide, you know that the outcome either is whether I'm going to get profit or loss, but you don't know which one will come, which one is certain to come. So that's basically. Then the third one is called decision making under uncertainty. This one basically, you are not sure of the possible outcome, but you still have to decide. So a definition: decision maker has little or no info about what? The probability of outcome. They don't know what's going to happen, the outcome is going to come out. Making it difficult to predict results. So in this one, you just hope that the decision is going to work because you don't know what the outcome may be. Features here is that lack of reliable data on past experience. Means what? Maybe you're making decision for the first time. So you don't have even what? Historical data to refer to. Number 2 is what? High ambiguity and unpredictability. You are not, it's very ambiguous because you don't know the outcome, possible outcome at the same time. You cannot predict what could be the outcome. Then example, launching a new technology product in completely new market with no existing data. You come with a new product in the market, there's no existing data on sales, on maybe competition, you just come for the first time. That's called what? That's called decision making under uncertainty. The next one is called decision making under conflicts. When there's tension, there's some conflict and you want to decide, that's also another tactic. So decisions are made when different stakeholders have conflicting interests or objectives. Means everybody is pushing on their side. Customers are talking about what they need. Suppliers here, employees here. Everybody is pulling in different directions. So what happens? That's what? Under conflict. So features here is that require negotiation and balancing different needs. So you need to call everybody on board to discuss. Help them board that please we'll make a decision that is able to at least take care of your interest or at least part of your interest. Then potential for disagreement and opposition. Some will still disagree or oppose the decision in the long run. So those are called what? Then example, negotiating a contract where the buyer and the seller have opposing terms. So everybody is a hardliner here. Supplier insists that I'm selling at this price. The buyer insists that what? I want to buy. So basically, unless they reach a compromise, they can agree. But if they're not able to compromise, it can what? They can go for long. Then we also have what you call decision making, group decision making. This is basically whereby people sit down, you discuss, and then what? Make a decision as a team. So decision made by group or team rather than what? Individual. Characteristics what? Multiple viewpoints and expertise. Maybe if you are 10 people, if everybody give their view and you analyze the situation, basically you can make the best decision. Then can improve creativity, and buy-in may be slower. Buy-in may be slower because what? Agreeing on the best decision can be a problem. When you're a group, you can discuss something very extensively, but the problem is that now agreeing. Which one do you agree on? Sometimes people may not agree. Reaching a consensus can then what? Risk of groupthink if not managed well. Groupthink is a situation whereby you don't want to be seen as the odd one out. So if people say that we're going to decide on A, you also follow them. Although you can have a contract, you can have a reservation or a conflict or a different opinion, but say that watu wanane wamesema wanataka kufanya hivyo, mbona mimi ni oppose? Let me just also decide. That's called groupthink, whereby other group members don't want to be seen like what? The one that what is making the making the decision making to be long, or they are dragging others behind. So even if you disagree, you just say that, okay, that's called what? That's called groupthink. So it's very common in organization. So basically, those are some of what? Some of the types of decision making, or call them conditions on decision making. Are we good up to that point? Or I need to explain something? Excuse me. Are we good? Is everything okay, or I need to explain some parts? Are we asleep, or you are going for lunch? I may be here alone. Are we in class, or we have gone for lunch? I'm almost finishing, so please let's be active for a short time. We clear this part. Not teaching when people are not, you don't see people. Sometimes others are on lunch, eating. Others are driving while listening to you. Others are sleeping or waking up when you're almost finished. But those are things that are beyond your control. But I know that my class has got very attentive people, because the way I see you responding, you're very attentive here. Now let's look at challenges in decision making. It's not easy to decide. Even in life, deciding things is not difficult. It's very difficult. Deciding to invest in a particular project and not the other takes toll. I've seen people with money, but now the business to invest in is a challenge. And they say, let that money stay in my bank. I don't want. This one is good. No. If you talk to your friend, you ask your friend, what do you think about this? Oh, don't try. Don't try that. Another person, go for that. Say that, I've decided to go and do this business. A friend of mine advised me. Then another friend tells you, at your own risk. That is one of the most unstable business idea in this world. So basically, sometimes it's very difficult to decide. Now let's look at challenges. Number one is what? Information overload. If you have a lot of information, you may be confused. You don't know what to do. So the first challenge is what? Information overload. When you have so many information, you become overwhelmed, and now you are like confused. So just have the right information. Don't have excess. Number two is what? Incomplete or inaccurate information. If you give me wrong information and I depend on it to make a decision, basically, I'm going to make wrong decision. So talk about incomplete. You give me wrong, or you give me incomplete. You give me half-baked information. You don't give me full, and I depend on it. Then basically, I can make what? Wrong decision. Number three is what? Time constraints. Some decisions require time, but now I have only few minutes to make a decision. So because of lack of time to analyze situations, I may make wrong decision. It's a challenge. So pressure to decide quickly can cause rushed or suboptimal decision. Means what? Because I need to decide very fast, I may not analyze the situation very much, and I may end up what? Making suboptimal decision. Number three is what? Emotional bias. Personal feelings.
By defining what is a company, and then from there we look on basically the various characteristics or features of the company, and then from there we look on basically the classification of companies. How do we classify companies? Because generally we do have different types of companies. We are going to look on those different types of companies. But in this case, I want us to start by defining what is a company. And basically, in this case, when we talk about a company here, this one can be defined to be an association, of persons, which is basically formed for some lawful common purpose, and also registered in accordance with the Companies Act of 2015. So therefore, this is what is association of what? Of persons. Association of what? Of persons, which is basically formed for lawful common purpose, and also registered in accordance with the Companies Act of 2015. So that is the definition of a company. So what do you mean by association of persons? Association of persons, basically, this whereby, for example, we may agree to come together, and basically we start doing business together. We start doing business together. So therefore, association of persons, this basically whereby we have a number of individuals, two or more persons will come together. They agree to register a company in order to undertake some business which by the end of the day is legal, or basically a business which is what? Lawful. So that is basically the definition of a company. And basically, in this case, we are saying that this particular association of persons, by the end of the day, it has to be registered in accordance with the Companies Act of 2015. Because if, for example, today we have agreed maybe to carry on a business, and that business will be conducted in form of a company. So by the end of the day, we must register that company in accordance with the Companies Act of 2015. And I hope you can also be able to recall what we said in our previous class. Previously, companies were registered in accordance with the Companies Act, Companies Act, Cap 486, but this particular act has been scrapped and basically replaced by the new Companies Act, that is Companies Act of 2015. You may come across some old notes which are basically talking of Companies Act Cap 486. So that act has already been repealed. Basically, it has been done away with and replaced by the new Companies Act of 2015. So today, if you to register a company, either a private company, a public company, you must register that company in accordance with the provisions of the Companies Act 2015. Now, this act here, that is the Companies Act of 2015, Companies Act of 2015, basically provides some legal framework, regarding, number one, the formation of the company, formation of the company. How should a company basically be formed? So that is clearly stipulated under the Companies Act of 2015. It also clearly stipulates issues to do with the management of the company. How should the management of the company be, or who should manage the affairs of the company, and how should those particular affairs of the company be managed? That is also something which is clearly stipulated under the Companies Act of 2015. And also we have the aspect of liquidation. So liquidation, remember yesterday I said that liquidation basically is the legal process through which the legal existence of the company is brought to an end. That is also something which is provided for under the Companies Act of 2015. How can a company be liquidated? What are the grounds for liquidating the company? And maybe the various types of the liquidation. Now, in this case, other than the Companies Act, which basically talks about the formation of the company, the management of the company, the liquidation of the company. So we also have various, or basically we have case law, or we have various case law. In this case, when we talk about case law, this in other terms we refer to it as the judicial precedent. So what do you mean by the judicial precedent? The judicial precedent, basically, these are those particular rules. Or principles, which the judges will come up with. After basically deciding various cases. So mean that other than the formation of the company, the company's management, and also liquidation being governed by the provisions of the Companies Act, we also have various rules and also principles which have been formulated by the judges, also which basically provide some legal provisions regarding the formation, management, and also the liquidation of the company. Therefore, we say that in different topics, we will basically come across various rules, or basically various principles which have been formulated by judges, and which basically governs the aspect of forming the company, management of the company, and also the liquidation of the company. But majorly, most of the provisions regarding the formation of the company, regarding management, and also regarding the liquidation of the company, they are basically contained under the Companies Act of 2015. And therefore, most of the things we will discuss in this unit here, they are purely contained in the Companies Act of 2015. Now, in this case, we can proceed and look on what are the features, or basically what are the characteristics of the company. So let's look on the features. Take into account, we have already defined what is a company. We look on the features, or basically the characteristics of a company. What are the features, or basically what are the characteristics of the company? Number one, we can talk of something called the separate legal personality. Personality. So basically what this means is that once, for example, you come together and maybe you have registered a company with the registrar of companies, that company becomes a legal entity, which is separate and also distinct from its members and also its directors. So once a company has been registered here with the person called the registrar of companies, in this case, we say that there exists a kind of a shell, or basically a kind of a shield, which basically separates this company from its members, and also its who? Its director. So what that means is that if today we have agreed to register a company, once that company has been registered with the Registrar of Companies, the company becomes a legal entity. That's why you see that a company is legally recognized to be having the same status just like you. So if you register a company today, that company has to pay tax to the government just like you. That company has the capacity to enter into a contract just like you. So once, or basically what that means is that once a company has been registered, once the company has been formed, a company becomes a legal entity, separate and also distinct from its members and also from its who? Director. So a company is not the same with sole proprietorship business, because if today you form a sole proprietorship business, that business is basically viewed to be the same with the owner. So if, for example, we come together, we form a partnership business, that partnership business is not separate from us as the partners. So that's why you see that if the partnership business is not able to pay its debt, the partners must come in and know how those particular debts will be paid. But in case of a company, if we register a company today, a company has that aspect of the separate legal personality. If the company is not able to pay its debt, those are not our debts as the members. So if the company has maybe entered into a contract, that is not our contract. If the company has some assets, are those our assets? No. So therefore, that is one of the characteristics, or basically one of the feature of the company. Number two, we say that the company has something called the limited liability. The limited liability. Limited liability basically means that if, for example, the company is not able to pay its debts, and then the members of the company will not be required to come in and do what? Contribute money to pay the debt of the company. So in other terms, this means that the liability of members in a company is what? Is basically limited. It's actually what? Limited. So if the company is not able to pay the debt, then the members do not have any responsibility as far as the payment of those particular debts of the company are concerned. In other terms, we can say the debt of the company are not the debt of who? Of the members. So the members cannot be called upon to come in, contribute money to pay what? To pay the debt of what? To pay the debt of the company. So the other feature, or basically the other characteristic of the company, is something called number two. Also number three, that is number three, we have what? We have perpetual succession. Perpetual succession. Perpetual succession, or basically we can refer to this as permanent existence. Permanent existence. Permanent existence. What does this mean? Permanent existence. It basically means that once a company has been registered, a company based, or the life of the company is continuous. Because when we talk about something or continuous, this is another name for, sorry, perpetual is another name for continuous. The life of the company is continuous. The life of the company is continuous, or basically the life of the company is what? Perpetual. What this means is that if, for example, something happened to a member, or basically then a number of members, that do not in any way affect the company. That do not in any way affect what? The company. A company cannot be liquidated because maybe something has happened to a member. For example, maybe one of the members has died, or maybe one of the members has exited the company, No. So the life of the company is continuous. So once the company is formed, even if, for example, some of the members exit, some of the members are declared bankrupt, some of the members die and they leave the company, that do not in any way affect the life of what? Of the company. It's not like a sole proprietorship business, whereby if the owner dies, that can lead now to the closure of that what? Business. Equally, like what happened in case of partnership. If maybe one of the partner dies, one of the partner maybe retires, that can lead to the dissolution of a partnership. That is not the case when it comes to the company. The life of the company here we are saying is what? Is continuous. So if a member exits or something happened to the member, that do not in any way affect what? The life of what? Of the company. Number four, we can say the company has got something called the common seal. Common seal. So when we talk about the common seal, this is basically equivalent to the company seal. By saying that the company has got a company seal or a common seal, it basically means that the company has the capacity to sign its documents, to sign its what? Its document, to sign its what? Its document. So for any legal document to be deemed to be authentic, that document must be having a company seal. So therefore, a company has a common seal. The company, or that means that the company has the capacity to sign its own document. And take into account the company itself does not have, or basically the company do not have that ability to sign, basically to sign the document. Any document of the company, for it to be authentic, we are saying it must be having what? A common seal. A common what? A seal, or a company seal. So the other feature of basically the company number 5, we can say that the company has the contractual capacity. The company has got contractual capacity. Contractual capacity basically is the ability. This is the ability to enter into contract. The ability to enter into contract. The ability to enter into what? Into contract. The company has the capacity to enter into contract. But basically, those contracts which are entered into by the company, are they entered into by the company itself? No. So any contract which is entered into by the company is entered into by its directors. By it who? By its directors. By its directors. So the directors are the ones who enter into contract on company's behalf. But by the end of the day, those are contract of the company. They are not contract of directors, because the directors here were acting as the agent of the company. They were acting as what? As the agent of the company. They were acting as the agent of what? They were acting as the agent of the company. So number 6, we can say the company can sue or be what? Or be sued. The company can sue or be sued. It basically means that the company here can go to a court of law, take a legal action on behalf of, or basically take a legal action against a third party. And generally, the company here, or the person who will be going to a court of law to take that legal action, is basically like the management, the directors, or maybe the company's lawyer instituting a legal action on company's behalf. The company can sue in a court of law or can be sued in a court of law. So number 7, we can say here, the company has capacity to own property. Capacity to own what? To own property. The company has got the capacity to do what? To own a property. So just like a natural person, the company has the ability, has the capacity to own the property. In fact, those particular property, those particular assets which are in a company, they are not assets of the members. They are basically what? They are basically the property or asset of the company. Simply, in this case, we have said that there is that aspect of the separate legal personality. If we have come together, we have formed a company. Those assets which exist in that company, those property which exist in that company, they are not our own asset, but basically they are assets of who? Of the company. So then the other feature of the company we can say is something called voluntary association. Voluntary what? Association. Voluntary association. So in this case, a company here, remember by definition, you have said is an association of persons. Association of persons. That association is voluntary. You can't be forced to be a member of a company. It's a voluntary. You must voluntarily accept to be what? Maybe to be a member of a company. You can't be forced. You can't be what? You can't be forced. The other feature of the company, number 9, is basically something called the transferability. Transferability of interest. Transferability of what? Of interest. When talk about the transferability of interest, it basically means that the interest in a company can be transferred. And how is your interest, or basically what is your interest in a company? Your interest in a company is basically measured in terms of the value of the shares you hold in a company. Once you are a member in a company, you have some interest, and your interest is equivalent to the shares you hold in a particular company. You can be able to transfer your interest. You can be able to transfer your shares. Though in some companies, like in private companies, the transfer of the shares is restricted. The transfer of shares is what? Is restricted. So restricted in the sense that you cannot be able to transfer your shares just to any other person. Just to any other person. You wake up today and maybe you decide that you'll sell your shares to any other person. There is some restrictions in relation to that. For example, in a private company, the requirement is that if you want to transfer or you want to sell your shares, you can only sell those shares to the existing members. You cannot sell the shares just to any other person. So the shares can only be transferred to the existing members. But basically, we are saying that there is that transferability of interest. You can be able to transfer your shares in a company. So the other feature of the company, maybe number 10, we can talk of the aspects of management. the aspect of management. So who manage the company in this case? Who manage the company? So the companies basically are managed by an organ which is known as the board of directors. These are basically a feature which applies to all companies, that companies are managed by a board of directors. By a board of what? A board of directors. By a board of what? Of a board of directors. This board of directors basically comprises of directors who are elected by the members to be in charge of or basically to manage the affairs of what? To manage the affairs of what? Of the company. So therefore, this basically, among others, are some of the features or basically some of the characteristics of a company. Some of the features or characteristics of what? Of the company. So basically what that means that if you go to different companies, you'll be able to see those particular what? Features. So those features applies to various companies. So now, next, I want us to look on the classification of companies. Or basically we look on the different types of companies which we have. Classification of companies. Classification of companies. And I hope you're together up to that point. Are we together up to that point? Are we together up to that point? Are we together up to that point? Catherine, are we together? Steven, are we together up to that point? Yes. Yes, so we are together up to that particular point there. Can see someone is having a question here. Yes, so I think we're going to discuss on that case of salmon versus salmon, maybe somewhere. Catherine, we're going to talk about the case of salmon versus salmon and the company limited. Almost at the end, there is somewhere we're going to look on the doctrine of separate legal personality in details, almost at the end of this topic. So we will discuss more on that. Okay, so classification of companies. Now here we have various ways in terms of how companies are classified. Various ways in terms of how companies are what are classified. Various ways in terms of how companies are classified, or in other terms, we can say we have different types of companies. We have different types of companies. So number one, we have the statutory corporations. Statutory corporations, or in other terms, these are known as the parastatos. So what do you mean by the statutory corporations or parastatos? So these are those companies which are basically formed pursuant to a certain act of parliament or in accordance with a certain act of parliament for them to be able to provide some essential services to the members of the public. And these companies here, usually they are under the control of the government, or they fall under the public sector. They fall under the public what? Sector. Public sector entities are those entities which are basically established to provide essential services to the members of the public. And on the other hand, they do not operate with an objective of making what? A profit. So therefore, these are those companies which are formed in accordance with a certain act of what? Of parliament. A good example of this is 𝐎𝐍𝐋𝐈𝐍𝐄. A good example of this is 𝐎𝐍𝐋𝐈𝐍𝐄. If you do some research, you'll be able to see that 𝐎𝐍𝐋𝐈𝐍𝐄 is a statutory corporation which is formed in accordance with the Accountant Act. Which is formed in accordance with the Accountant what? Accountant Act. Accountant what? Act. Now, on the other hand, we have said that these particular entities are basically formed to provide essential services to the members of the public, to the members of the public, meaning that these particular entities, these companies are not formed with an objective of making profit. With an objective of making what? With an objective of making profit. And therefore, these particular entities will basically continue operating even if they are making losses. They are making losses because we are saying that their main objective is to provide some essential services to the members of the public. Now, in case they make any profit, that profit may be plowed back, may be reinvested back or that particular profit may be paid to the government as dividends. Remember, these entities are under the control of the government. So if there's some of the parastatals basically make good profit, and basically what they do, they pay part of the profit they are making to the government as what? As dividend. So we are saying the profits they are making can be plowed back, can be reinvested back, or can actually be paid to the government in form of what? In form of dividends. So how is their capital raised? How do these parastatals raise their capital? These parastatals basically raise their capital through borrowing, and basically that borrowing is guaranteed by the treasury. So the government or the treasury is actually the guarantor. In case these parastatals are not able to repay back the amount of capital they had borrowed, who is supposed to pay that capital is automatically the government. So then from there we have the other type of company, and that is basically the registered. In other terms, we also refer to this as incorporated companies. Incorporated what? Companies. Incorporated companies. Now, when we talk about the incorporated companies, incorporated or the registered companies, number one, these are those companies which are formed in accordance with the Companies Act of 2015. They are formed in accordance with the Companies Act of 2015, and therefore, in a private company, the public company, and so on, they are good examples of the registered or the incorporated company. So these are those particular companies which will be formed and also registered in accordance with the Companies Act of 2015. So after these companies have been registered, after they have been registered with a person called the Registrar of Companies, they will be issued with a certificate of incorporation. They will be issued with a certificate of what? Of incorporation, in which case then these particular companies shall be regarded to be separate legal what? Separate legal entities from their members and also from their shareholders. From their what? The shareholders. And actually, these companies here, their powers and also what they do, that is something which is clearly defined under their constitutions. And basically, these two companies, they have two main types of constitution. The first constitution is known as the Memorandum of Association, and the other constitution is known as what? The Articles of what? Of Association. So in other terms, you can say that they derive their powers from these two constitutions, the Memorandum of Association and also the Articles of what? Of Association. So then from there, we can proceed and look on the other type of companies, number 3, and that is the chartered corporations. Chartered corporations. Now, chartered corporations, these are those particular companies which are basically formed upon being granted a charter, basically by the president. Usually, the companies which fall under this category are universities. Are what? Universities, because basically what we know is that for any university to be able to offer various programs, various certificate, diploma, degree, master programs, it can only be able to do that upon being granted a charter. Upon being granted a charter by who? By the president. By the president, who is basically empowered to do that under something called the Universities Act. The Universities Act, the president is empowered to grant a charter to a university if, for example, the president will be is basically of the opinion that that particular university will basically do what? Help the country in terms of development and promotion of what? Of education. So therefore, these are those particular companies which are basically formed upon being granted a charter by the president, who we have said is empowered to do that under the Universities Act. And I've said good examples of this are what? Are the universities. Are what? The universities. Then from there, we have number 4. Number 4, we can talk of private companies. We can talk about private companies or private company, basically. A private what? A company. So private company here is actually defined under the Companies Act because one, a private company has to be formed in accordance with the Companies Act of 2015. And the Companies Act of 2015 defines a private company as what? Or we can say a private company. This is a company which by its articles of association, of association. So when talk about the articles of association of a company, articles of association of the company, this is actually an internal constitution of the company. An internal constitution means that this is a document which contains some rules and regulations regarding how the affairs of the company will be managed, regarding how the internal affairs of the company will be will be managed. So this is defined to be a company which by its articles of association number one, restrict the right of members to transfer shares. Restrict right of members to transfer what? To transfer shares. So if, for example, you're a member of a private company, your right to transfer shares is usually restricted. So what does that mean? It basically means that if, for example, you want to transfer, or in other terms, to sell your shares, so there is some restrictions as far as that is concerned. And I think I've given a good example that if, in case you want to sell your shares in a private company, you can only be able to sell those particular shares to the existing members. You can't sell those particular shares to just any other person. So number two, we say is a company which by its articles of association limit the number of members to 50, limit the number of members to what? To 50. Limit the number of members to 50. The number of members in a private company cannot exceed 50. And number three, is prohibited from inviting members of public to buy its shares, or in other terms, to subscribe its shares or debentures. So it basically means that in case a private company want to issue shares, it can only be able to issue shares or even debentures to the existing members. It cannot be able to invite the members of the public to come and buy its shares or debentures. So therefore, this is the definition of a private company. So we have said it's a company which by its articles of association, number one, restricts the right of members to transfer shares, limits the number of members to 50, and number three, it is prohibited from inviting the members of the public to subscribe its shares or debentures. Its shares or what? Or debentures. Now, before we proceed to look on the other company here, we can proceed and look on the other features, or maybe we proceed and look on more features, or basically the various characteristics of this company, because it is important for you to note that this is basically one of the common type of a company, which is basically formed by individuals to do business. In most of the cases, if today you want to register a company as an individual, you will be registering a private company. You'll be registering a private company. This is therefore one of the common type of company. So one of the features of this company, number one, is that private companies have a minimum, or basically in other terms, you can say, must have a minimum of one member and one director. One member and one director. So according to the new Companies Act, or basically according to the Companies Act of 2015, so for this company to be formed private company, it requires a minimum of one. But the repealed Companies Act, that is Companies Act Cap 486, it was requiring a private company to have a minimum of two members. But today, as an individual, you can register your own company as a single individual. So it requires a minimum of one member and one director. One member and one director. So that is one feature of this private company. So the other feature of the private company, we can say that this company can basically commence business upon incorporation. Incorporation is basically the process through which a company is registered with the registrar of companies. So once this company has been registered with the registrar of companies, remember you have said that the registrar of companies will issue something called the certificate of incorporation. That company can start to operate upon receiving that certificate. But we will be able to see if, for example, you are registering a public company. For that company to start operation, it's required to get another certificate still from the registrar of companies known as a trading certificate. But this company was registered, issued with a certificate of incorporation, it can be able to, or it can start, or it can commence business. So the other feature of this company, I think that is something I've mentioned here. It restricts the right to transfer shares. Right to transfer what? Right to transfer shares. So if you're a member of this company, your right to transfer shares is restricted. Now, this restriction for the transfer of shares is achieved in two ways. In other terms, you can say that this restriction regarding the transfer of shares is restricted in two ways. One is through something called director's discretion. Director's discretion. Director's who? Director's discretion. Basically, what this means is that, or basically this document here, that is the Articles of Association, which you have said is an internal constitution. We have said it basically requires that in case you want to transfer your shares, to transfer is basically to sell your shares. So in case you want to transfer your shares in a private company, you must first of all inform the directors of that company. Inform the directors that you want to sell your shares. Now, once you have informed the directors are empowered by this document, by the internal constitution, basically to do what? To decline you, or basically the directors do have that particular power not to give you a permission, or basically a consent to go ahead and basically do what? Sell your shares. They can tell you that you will not sell your shares. You'll not do what? Sell their shares. In other terms, once you have informed them you want to sell your shares, they can decline to register that transfer of shares. So once they have declined to register your transfer of shares, it means that you can't be able to go ahead and you do what? You sell your shares. So that is one way through which the free transfer of shares is restricted. Number two, it is also restricted through something called the pre-exemption clause. Pre-exemption clause. So this is still a clause which is contained in this document, Articles of Association, and which basically requires that in case you want to sell your shares in a private company, you must offer for sale those shares to the existing members. You can't offer for sale those shares to just any other person. This clause requires that you must offer for sale all the shares to who? To the or basically you must offer for sale those particular shares to the existing members of what? Of the company. This particular clause is meant to ensure that in case you are selling your shares in a private company, you are not just selling those shares to any other person, but basically you are selling those shares to who? To the existing shareholders of that company, to the existing shareholders of that wood, of that company. Yes, so those are basically two ways through which now this free transfer of shares is actually what? Is actually restricted. Maybe we can also say that or the other feature of this company here, number 4, we can say limit the number of members to 50. Limit number of members to what? To 50. So the number of members in this company cannot exceed what? 50. Cannot exceed what? 50. So those are basically some of the features of this private company. So then we can proceed and look on the other type of company. Remember, this was under number 4. So number 5, we have public company. Public company. What is a public company? Public company is also defined under the Companies Act, and the Companies Act defines this, or we can say that a public company, this is a company which by its articles of association, number one, do not restrict members' rights to transfer shares. Members' rights to do what? To transfer shares. So in a public company, the right of members to transfer shares is not what? Is not restricted. And number 2 here, we can say that this one is not prohibited. From inviting members of public to buy its shares. Not prohibited from inviting the members of the public to do what? to buy its share. So this company can invite the members of the public to buy, or in other terms, to subscribe its shares or debentures. And we will be able to see that whenever a company is inviting the members of the public to buy, to subscribe its shares, that company does that by issuing something called a prospectus. By issuing a prospectus. A prospectus is any invitation by the company to the members of the public to buy or to subscribe its shares or what? Or debentures. Number 3 here, we can say its certificate of incorporation. Each certificate of incorporation clearly states that it is a public company. State that it's a public what? Company. So this is the definition of a public company under the Companies Act. Under the Companies what? Under the Companies Act. Specifically, if you go to, and this is a document, in fact, you should be able to download. If you go to any browser, you type Companies Act of 2015 PDF document, you should be able to get this act. Sasa? Yes, so it's good you have this particular act, because I've said most of things we are running here, they come from this act. Specifically, for example, in this case, if you download this act and you go to section 10, of this act, this is where you get this definition. That's why you get this word definition. Yes, that's why you get that definition of a public